We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome back, everyone. Hope you guys are having a great day, as always. And we're going to get started here today discussing all the topics that I've outlaid in the title. If you guys want to, refresh the title so you guys can see the updated list of topics and in the description below. So I want to start off by actually asking everyone to answer the chat. Or in the chat, the poll, and I'm just trying to gauge what the audience actually feels about fintech in general, because within the club and I think within previous live streams, it's been a while since we live streamed, we've discussed the prospects of fintech. Definitely within the community, we've been discussing some other fintechs, not just PayPal. PayPal is probably the most popular among retail investors right now, but fintech is a very large sector with a lot of different players, and depending on how you want to play it, there's different ways to get exposure to different segments of the value chain. So, for example, technically like Visa, MasterCard is fintech. So you could consider that. It's not just PayPal, even though, again, PayPal is the one that's talked about the most, and thus in the title. And then you have some other payment processors or gateways. You have global payment systems, Fiserv, Fidelity systems. Global Payments is actually, not Global Payments, WorldPay is actually being spun out again. So you're going to have another one. You have Payoneer, Stripe, which is private, Adyen. But yeah, we'll talk about that as we get there. Okay, real or fake bricks? The debate will always remain. So yeah, these are in fact, just made up bricks. They're not real bricks. Confirmed now. Fabio hitting the back alleys, teaching finance to urban communities. That'd be funny. Okay, what is Fidelity? I only know Fiddly. Well, Bacon, not everyone knows the inside jokes. Not everyone knows the inside jokes, but Fiddly is the funny joke. All right, so let's begin with the first topic. So that is bank earnings. All right, so I'll go ahead and start sharing my screen here. Let me just pull up the first bank that we'll be discussing, which we'll talk about Citigroup first. We'll start with Citigroup because Citigroup's the uglier bank. Okay, and let me minimize this. Should have had this already set up, ready to go, but we shall focus on that. Okay, kind of put you guys right there, and I'll zoom in, zoom out a little bit. And where am I? I need to put myself in here. All right, I'll put myself here in the corner. Okay, so, and then I'll put this, let me just organize this so I have the comments so I can see what you guys, or if you guys are asking any questions at the same time. Again, reminder, as people join in, answer the poll that I have. It's just for me to gauge when we get to the conversation on fintech. So I'll have something to discuss with. I got to get a feel for what you guys are feeling regarding fintech. So it's a yes or no. Either you're buying or you're not buying it. I should have probably added a third that you're looking at fintech, but you haven't bought yet. So some of you that are no might be, not opposed to it, but you're kind of just waiting on the sidelines. So let's start with Citigroup here. So Citigroup historically has been the ugliest of the big money center banks. Typically, if you look at internal return metrics, Citigroup has performed rather poorly. So we've discussed within the club many times comparing different banks to each other. If you're new to the channel, and I'm not gonna, not discuss this because I think it is valuable information, but you should not use book value as a broad metric all the time for banks. It is a really good smell test, but it's not the appropriate or applicable metric to use, broadly speaking, just blindly. Right? It's an additional, it's perhaps like a good introductory method to evaluating the expensiveness or cheapness of a bank. And then there's further investigation that's necessary to evaluate whether or not the book value discount or premium is well deserved. And one of the ways you can come to that conclusion is by looking at some of the internal return metrics of a bank. So Citigroup has been one of the poorest in that category, in that specific metric. So you can look at, return on invested capital, return on equity, return on equity employed, et cetera, et cetera. So Citigroup has been undergoing a change to the new CEO. She has done a good job, I'd say, but what previous discussions to kind of bring everyone up to speed, because I can't assume that newer people have listened to previous commentary on Citigroup. But essentially what you have with Citigroup is a lot of counterparty risk that's unknown. It's kind of like investing in a black box of sorts. And it makes it rather difficult to establish a fair value. One of the things that retail investors really get gravitated towards with Citigroup is the book value metric that I was just alluding to. The book value, I believe, it's trading at half or below half of book. I think it's like 0.4 book. And so retail investors look at that and say, it's below book value. It's a 60% discount to book. I should buy this because, you know, number makes sense. Number low and number means cheap. So I buy. And that analysis doesn't go as deep as it should. Well, it actually might end up working out if the CEO does do what she says she's going to do, by the way, because it might be right for the wrong reasons. And so when you apply that consistently across time, you're going to make more mistakes than successes because you were not right for the right reasons, you were right for the wrong reasons. And so you go to apply that same logic elsewhere and you get clapped. So with the case of Citigroup here, the CEO, she's been transforming the business, focusing on cost cutting. They have been executing well in that. Some of their businesses have been performing well. Some of their businesses have been performing terribly. They have exposure across the world. I look at Citigroup as more of an international bank. They have a lot of exposure to developing markets. They sold their China business. So that's something that I think is a positive. I don't think the financial institutions of the United States should be involved in China. China is not a pure free market state. It has free market elements, and in some cases, probably more free markets than other parts of the world, but selectively speaking, as long as it pertains to the benefit of the state. And so any geopolitical hiccups that occur, you run risk of losing the entirety of the value. I have plenty of videos on the China situation. I have not made any new ones. I've alluded to, by the way, follow me on Twitter. If you don't follow me on Twitter, I've alluded to on Twitter that I should probably be doing a victory lap on the China discussion, because a lot of the things that we discussed regarding bankruptcies, fraud, et cetera, are occurring. And some of the other questions haven't been settled regarding Chinese assets. But Citigroup here exiting the China market, I think, is a positive for the bank. But there's still a lot of room for improvement from Citigroup. So there's a lot of cost cutting measures. I'll discuss some of or quote the CEO, paraphrase, better to say, the CEO, what she said in the call. So they realized that there were business processes that were being conducted by a certain branch of the business, and it was being almost done twice, and extending the time at which a portion of the business could undergo an action. And so they've been cutting that across. So there was a human resource department that I think she quoted, or again, I'm paraphrasing her because it's already been 2 days since we've listened to it. But she noticed that one business unit was basically involved in, kind of checking the decisions of another business unit, and they were not even in the same region. And so by removing that one business unit, they could save money on the salaries that they were paying, and they could improve the efficiency of execution of that other business unit in that other region. And I don't think she specified what region it was that was being, let's say, roadblocked by the business unit. I think it was one of these islands or whatever. But point is that she's looking across the entire organization. She's noticing how complex it is, and I like her strategy. So what I'll say positively about Citigroup is if the CEO executes on what she's promised, the company could be seen, or could be actually an attractive buy here. But there's a lot that could go wrong between point A and point B, again, because there's a lot of counterparty risk that if we have some sort of financial crisis, asterisk on financial crisis, it could be whatever, formation that you can imagine. Doesn't have to replicate or look like the 2008 financial crisis, but I'm saying just any situation, any liquidity issue, liquidity crunches, whatever, could actually harm the bank tremendously up until that point if they're not prepared for it. They have exposure to Argentina. They talked about that in the earnings call. Of course, Mexico, I think, is more of a benefit. However, asterisk on that, because any exposure they have outside of the United States, there's a lot of uncertainty in the emerging markets segment. But exiting China, again, that's a positive, I feel. And I think that they did so because they concluded a similar risk. So are you buying a bank? I have banks in the portfolio. The holding co has been more aggressive in buying some banks recently. But I'm not opposed to discussing directly, except the club members are what get the allocation, dollar figures, et cetera, of the portfolio. but I'm not opposed to necessarily not discussing companies. The company in question, I have one regional bank that has been technically two, because US Bank is the one that I guess the public knows about. But US Bank Corp is one of the regional banks I'm invested in. And then I have another smaller regional bank that benefited from the recent banking crisis. But in general, I'll go over some of the reasons why I like a company like US Bank Corp, and why I have a muted exposure to banks as a whole. So banks, I never really make them as a totality a massive portion of my portfolio. They don't make up ever and have ever made up a portion akin to what tech makes up today. The largest exposure to banks in my portfolio's history was around the 2020 mark. That was perhaps the largest they've ever gotten to percentage-wise of the portfolio, and they never gotten back to that. Just simply because we want to mitigate the exposure to a business model that frankly has a lot that can go wrong, a lot that is very difficult to predict whether or not it can go right or wrong. But in general, some of the things I like about US Bank Corp, which is getting back to your question, is the US Bank Corp has a lot of really favorable internal return metrics. They're a very efficient, well-run bank. Their duration risk is also quite low. When I say duration risk, I'm referring to the average amount or time period in which their assets will mature. And so that gives you some things that you can kind of think about. Critical thinking, right? You start to say if the average duration is about 7 years and the renewal rate of that portfolio, roughly speaking, is 7 years. And so if rates are going to go higher, the bank with the lower duration risk is going to be able to renew that portfolio at higher rates and benefit from that. Which that's actually a really good segue into getting into JP Morgan Chase, which JP Morgan Chase, with the acquisition of First Republic, we did a all hands on deck live stream back in when the banking crisis was occurring with First Republic. The statements I said to bring you up to speed was that First Republic, anyone who acquires First Republic would benefit tremendously because it's like picking up a dollar off the ground. The credit risk profile of First Republic was very minimal. The only risk for First Republic was liquidity. So they lacked the ample liquidity to satisfy the needs of their clients who wanted to withdraw, but the loan portfolio was very valuable. It was essentially going to mature at exactly the value that was owed. And so any bank that was able to acquire that portfolio would benefit tremendously. JP Morgan Chase stepped up to the plate, acquired that portfolio, and behold what you see in the recent earnings reports and the last two earnings reports. You see how much it's benefited the business overall. And so a large portion of that earnings growth, that book value growth on JP Morgan's accord has been from that acquisition of First Republic. So very good acquisition by them. And then JP Morgan as a whole, as a bank, compared to the likes of Bank of America, has a much lower duration risk profile. I think it's even lower than US Bank Corp off of memory. And what that means is their portfolio churns or renews at a much faster clip than something like Bank of America, which I believe is above or close to 20 years. So what that essentially entails is that when rates rise, the value of their loan book is going to decrease at a less impactful rate than Bank of America. And then Bank of America has been extending their portfolio out in trying to reach for duration. And so the likes of JP Morgan Chase is able to benefit from any short-term volatility because they will have ample liquidity to adjust. And so right now what we're seeing is JP Morgan Chase's loan portfolio is renewing at a faster rate than the other banks, and that's benefiting them because as rates are much higher right now, the new loans that are coming into their portfolio are at much more favorable rates. And I've noticed that JP Morgan Chase has actually extended a little bit further out on the duration side, so they're loaning out further out. And that's more indicative that the bank might be betting on rates not rising, which actually is what they said, that they are prepared for it, but they don't think rates are going to rise too much further from now. So if you take them at their word and you look at their actions, it seems like their actions are aligning with their words. And I said this in the past, and one of the members actually reminded me in the recent call that I said a long time ago when we talk about banks that you want to look at what the bank CEOs say and then also look at what they do. And sometimes you'll find differences between what the CEO will say and what the bank will actually do. And you want to kind of test the two and see if they align, because always go with the action rather than just the words. The action is more powerful than the words. Bank of America CEO continues to be the most positive, among the most positive CEOs. He's still talking about soft landing. He's been kind of fluctuating on that a little bit. I remember making live streams or videos about him kind of becoming a little bit more bearish towards the tail end of last year, but now he's back to being more rosy. Of course, he would have to think so, again, because Bank of America has a lot of duration risk. And if you're wondering why Bank of America, let's actually pull up Bank of America, has been underperforming so much. It's a lot to do with that extended duration risk. So it's not a credit risk issue. It's just a duration issue. And so up until 2023, no one really cared about duration risk within banks. Now everyone cares about it. Because it's not really something that we've been thinking about in the environment of yields just coming down or rates coming down. That's not the issue that investors care about. Investors cared about coming out of the great financial crisis. What is your credit risk profile? Show me what's the likelihood of your loans coming or maturing at the value. What's the likelihood that people don't pay your loans? That's what people cared about. And then as we entered the liquidity crunch in 2022, plenty of videos on that. And then 2023, kind of that extension of it. We have the banking crisis, right? And the banking crisis, now everyone cares about, liquidity issues and by extension, duration. So, which is why you might also think about the, ETFs like TLT that I've been getting asked about a lot. It's a product that gives you exposure to the 20-year plus treasury bonds, right? And so the average duration in this product is 25 years, I believe, something along the lines of that. And so the play here is as you extend the duration of a bond, right, the more sensitive it is to changes in interest rates. So if interest rates come down from here, this will do very well. If interest rates rise, this will do very poorly. But if you have a 1-year duration bond, that's not going to change really from the rise and fall of interest rates. So again, as you extend that duration, you get more sensitivity. There is actually one other investment that actually would make this look conservative as far as exposure to long duration. And I'm not talking about the triple leveraged version of this product, because that exists. I think that's extremely dangerous because you have to time that. So not only do you have to be right about the direction on pretty much a macro prediction, but you also have to be very right or spot on in terms of the timing of it, which makes the leverage product even more dangerous. But no, there is an actual common stock out there that I've discussed before. That's good. Okay, so that pretty much covers Citigroup's earnings, but JP Morgan's earnings, pretty much in summary, is rosy as ever. As far as just executing on all things, they're either number 1 or number 2 in every business line that they're in. So the market understands that, therefore premium to book is justified in my opinion and everyone's opinion. It's not really a nuanced viewpoint. And the other points of JP Morgan Chase, it appears as though in the era of consolidation, in the era of increasing regulation, they stand to benefit across the board. So they talked about that briefly in the earnings report, but they didn't say it as direct as I'm saying it, but I'll say it directly because I don't care. But yeah, any regulation that increases in the banking sector would benefit JP Morgan Chase almost exclusively, even though maybe the media might not report it as such. The media might report it as, it's, make it more stable, which, it could, I don't know. But the point is they're going to be able to, as far as their more direct competitors in the regional space, like let's call it large regionals, slightly entering into mega sized banks, those are not going to be able to compete as effectively as maybe they once were able to. And so there's going to be probably further consolidation at the top end, a la Truist, which is the combination of SunTrust and BB&T. And I think the club members described it perfectly as almost being like a handshake deal between a CEO that wanted to retire and a CEO that wanted to grow the business massively. So it's an amalgamation of two, I would call it meh banks, to try to make a better bank, and they are slowly executing on that. But I guess I'll also update that Truist recently sold their insurance business, and I don't think it's the game changer that the market perceived it in the beginning. I had some time to digest it. So Truist was a position within my personal holdings, as you guys who've been following the portfolio updates have known. I exited Truist at a loss. I think it was a pretty substantial percentage loss, but as far as dollar amounts, it was the small position. Again, you can go check back older portfolio updates, but The point with Truist was kind of betting on the execution by management to actually affect change in a positive way, but there's still a lot to be had. Like, we don't even know what Truist is going to fully specialize in, or what the market will respect it as in terms of specialization. Most banks that you look at have some sort of trait that they specialize in that differentiates them from the other banks when you invest in them. So, for example, you can look at U.S. Bank, that will be a custodian of sorts. Same with Bank of New York Mellon. You can also look at JP Morgan Chase, kind of known as the bellwether bank. Bank of America, you would expect to have a very strong presence in consumer banking for that upper middle class segment, and also strong energy loan portfolio that and then Wells Fargo, you'd have a portfolio that extends a little bit more deeply into concentration of home loans, which, by the way, Wells Fargo, I used to say in the past, and just for the point of record, Wells Fargo is not the largest home lender anymore. They're not the bank with the largest mortgage portfolio. That is no longer true. The new bank that has the largest loan portfolio in home lending is JP Morgan Chase. So for the record, what I said in the past, if you watch older live streams, that was true then. This is now the current fact. The current fact is that JP Morgan Chase is now the largest mortgage lender, or has the largest mortgage portfolio. That's the better way to say it. They have the largest mortgage portfolio. So now that that's stated, we can move on or come back to it. And that pretty much summarizes the earnings report of JP Morgan Chase, a little bit tidbits of Truist. But now on to the next topic that we'll get to. Going through some questions here. Let me see. Okay. Oh, that is true, SH. So I'll say the ticker. So because sometimes my brain is maybe moving a little bit further or ahead than my mouth. So I go on to like the next topic. But that's why I read the comments. So you guys always feel free, if you have a question, that's what doing this live is for. You just ask me the question. But yeah, good point. So the ticker of the other one is SAFE, SAFE. So Safe Holdings. I believe it's Safe Holdings. Let me actually just put it up. And you'll see it on the screen here. Safe Hold, not Safe Holdings. Safe Hold. So there's a lot of risk in this entity. If I'm going to bring it up, I'm not going to just put it out here, but I'm going to talk about the risks. And I'm not even going to talk about the bullish narrative. I'm just going to literally outlay the risk, because the risks are quite large. One, this is a complicated entity to kind of understand for most people. If you actually look at how they calculate the discounted value of the properties that they acquire, it's a bit more of a complicated process. You need to also understand the duration risk is extremely high here, with you have lease terms, roughly speaking, of 90 years plus in some cases, but some very large extent like that. If you're going to do research or buy this company, please figure that out and then kind of map that out within your own portfolio, what that would look like, what kind of risk you're taking on. But yeah, Safe Hold, it is also a REIT, but you have, again, rates rise, inflation is high. This is not the instrument you want to be involved in. Inflation would be very detrimental, because I think the maximum they can raise the rents by, and they have a look back period after 10 years. So each lease agreement has like a 10-year look back period, but that only happens on the 10th year. So that's how these leases are typically structured. These are land leases. And I think the maximum increase is like 3 or 4%. So if inflation is higher than that, if we have a high inflationary environment, you can't even recover that. Actually, there'll be like an actual hit to the real value of that. So yeah, but that's the ticker. But obviously, well, I'll mention the bullish case. So the bullish case is if rates come down, this is going to actually meteorically rise. Unironically, like meteorically rise, because if you kind of think about it, the duration here is that of the 30-year on steroids, quite literally. So, and management will always hype out, what is the end book value of the company because of how many properties they're acquiring. So they're doing land leases, which at the end of the land lease, they actually keep the building as well. So they use that as a metric to highlight to investors or potential investors, hey, look at all the portfolio that we're acquiring, and at the end of this period of time, that's the total value. So they have those calculations provided to you. But you kind of have some caveats. There's also some critical thinking that needs to go in here. For example, at the end of a lease, how likely is the client or customer or tenant going to upgrade the property? They're probably going to pull back some of those upgrades because they know they're going to give up the building at the end of this lease. So that's just something that's far along into the future, but something to think about genuinely. And so you got to think about the maintenance of such buildings. If you're doing like a 90+ year lease, like how many buildings are lasting without proper maintenance over 100 years? So there is maintenance involved, and so you want to make sure that the tenants are doing so, and you're trusting that that's just going to happen, which could happen, but it's just more things to just think about besides just saying, buy it. Management says, look at the book value of the terminal portfolio in 90 years. It's under that, therefore we should buy it. Just think about it a little bit more. Okay, so let's see. We'll talk about American Express as well. I don't really have anything bad to say about American Express. Let me quickly go to, we'll go through American Express because then we'll go to the defense companies because I feel like that's properly put together. Or maybe I throw that into Fintech. We'll throw American Express into Fintech, so we'll get to that. Okay. Well, yeah, we'll come back to American Express. Hold on. I need to do that. Okay. Let's go through. Are you buying? So KKR isn't my style, but good luck with whatever you do. Oh, okay. That's another conversation. Optimistic Citigroup making a 20% position now. Go it. Thoughts on CCI? Okay, so Crown Castle International. The thing is, Crown Castle International has to figure out what's going to happen with the what are they called? Like the smaller units that they're installing. So there's the cell towers, which American Tower is more prominent in, and then Crown Castle International is more so exposed to that urban environment. American Tower, unironically, is the more international player. Crown Castle is more focused on North America, which some people like over, the likes of American Tower. Let me pull up the chart here. Well, I had no idea it fell under 100. Well, actually, it bounced. What was the low? 88.44. Interesting. Okay, so yeah, I didn't even know it fell below 100. But for me personally, it looks cheap on paper. Management's projections on growth seem interesting. Like they say, this is a temporary period, and that's I think the consensus among analysts. But for me personally, let me see real quick, because American Tower 166 comparison. Yeah, there is like a deviation here, but American Tower isn't facing the same exact issues that Crown Castle International is. So it's more unique to that. My thoughts on Crown Castle International, I'd have to do more research, but my surface level thoughts are just that I don't understand exactly what the issues are going to come about with the new implementation of 5G and then by extension in the future 6G. So I'll have to really look deeper into it because I don't have a fully fleshed out opinion. Okay. Let's see here. All right, we're going to go into the next topic. What are your intrinsic value come up for DG? I see their fair value at about 85. I already shared that with the club, but it's roughly, as far as like extreme interest, would be actually in this range, and then anything below. So, but as far as anything below, I believe the allocation percentage target would have been close to like 3 to 4% in, I think it was like 88, something like that. It's been a while. Rise, are you trolling? Be serious. Oh, Rise Aries. What do you think about Chegg as a play on AI? No, not interested in Chegg. So Chegg as a play on AI as a disruptive education companies as the market is pricing in. No, I'm not interested in Chegg. Chegg, I think it's in fact, it's being disrupted. at this very moment. Some argue that it has a massive database that it can rely upon for, you know, the information that it gathers, but no, it's not. All right, so now the next topic that we'll be discussing is defense companies. So defense companies, there are people with more knowledge on this than I myself in the club, but generally speaking, we've kind of concluded that the defense sector might present an interesting opportunity at the present moment in time. Simply put, there's some catalysts that could push the sector higher. One, the recent underperformance by the defense sector. So you have L3 Harris. You have, oh, by the way, L3 Harris bought my company, Airjet Rocketdyne. So, you know, there's a little bit of a, not affinity, but affection from me, because some might argue that the acquisition was, you know, let's call it overpriced, but I'm okay with it. And then you have Northrop Grumman, which is in the portfolio. And you have the recent discussion we had on the submarine companies. Both of them are very attractive. But as far as the defense sector goes, we are actually entering, you could not call it total unfundment, but compared to historical rates as a percentage of GDP, we actually are on the lower bound of military spend. The current projection is we hit 3.1% by 2033, I believe the date was. So if we hit that, you know, normally we in modern history, we're in the 4 or 5 range. And during World War II, we hit 15. That's not really going to happen. But let's say hypothetically, you enter a scenario where military spend returns to about 4 to 5% of GDP. Well, that's already a huge boon, assuming GDP continues to rise or remains flat. And the direction of defense, right? You want to be focused on the areas of defense spending where the focus is happening. So that's submarine to kind of counter China. You also have space, right? But less so on the ground offensive. Again, as people who in the club have discussed, who are much more familiar with the matter than I, because that's more of their focus point, or, you know, where they've expensed a lot of their professional careers in. But L3 Harris is trying to position themselves better in that direction, right, with the acquisition of Airjet Rocketdyne. So that's rocket technology, hypersonic missiles in the future. You know, that's going to be a thing. And Northrop Grumman has better positioned themselves than most, you know, Lockheed Martin as well, for space or increases in space expenditure by the military. So, you know, we're looking forward to that. And in general, we're probably going to be focusing more so, like Northrop Grumman. I would like to acquire more shares of Northrop Grumman. But L3 Harris is another one that I've been buying a little bit here and there. So let's see. I have Dollar General 140, 150, but better to have the cushion of safety. Yeah, for sure. Let's see. In your DCF DG, did you include lease obligations and their total debt when calculating the equity value? Well, the lease obligations, they are, like, the new accounting standards did change to account them for more, to highlight to investors that they are like a form of debt, right? But they're not actually, like, you know, form of long-term debt. But they are, but they're not, right? So you do want to account for it, because you can't just break out of a lease agreement. So it's a good question, because you can't just, you know, say, oh, I'm not going to pay the rent anymore. But it's not going to be the same level of risk, I would argue, as like a, you know, long-term debt. The long-term debt is going to be more of an issue with retail companies. It's part of the course that majority of their properties they're not going to own outright. You have divisions within companies like Kroger, Walmart, Ingles Market, that they own portions of the properties. Ingles actually, I think, owns like 75%, something like that. But yeah, Target, they all own portions of the property. The lease obligations, they're going to be, you know, depending on, well, actually, I don't know the nature exactly of the agreements that they have, but Dollar General, being an investment grade tenant, probably has very favorable rental increases. Where again, when we talk about REITs, we talk about how if you have an investment grade tenant, there are benefits and drawbacks. The benefits are the security of the leases, but the drawbacks are, of course, the rate at which you can increase the lease year over year. or the rental rates year over year. And the initial starting cap rate is typically lower, again, benefiting the tenant. So I don't think it's that much of a problem for Dollar General compared to peers, right? All the top peers or top players, it's not really that much of a problem. When they have to, let's say, leave a property, Dollar General also has like a general policy of, I think it's like their minimum expenses or the maximum expenses is like $100,000 per unit. So they kind of plan the strategy around that. And they do have typically strong negotiating power when it comes to, cutting the lease entirely. So, and usually the REIT in general that owns the property, they're like, a lot of CEOs will talk about them. They're like boxes. And so they can be repurposed for other tenants when they want to. Can we look at Invesco? We'll look at some other companies, but I want to keep up to the topics at hand, and then we'll get to more of a Q&A section. No, Gary Dane. No, that's not a made up term. Investment grade, as far as the credit risk profile, a lot of REITs actually talk about that. So, for example, if you look at the likes of Agree Realty, they actually illustrate or break down their portfolio based off of investment grade, non-investment grade, unrated tenants. It's something that REITs do talk about as far as talking about the risk profile of their tenant base. So, it's not made up. The REITs do, in fact, discuss it. Now, there's no credit profile to the tenant, if that's what you're discussing or pointing out. That's for sure. That's obvious. The next comment is pretty obvious. Yeah, they label it in presentations. It's not, there's no credit, if anyone thought that, no, there's no credit ranking for a tenant, but there's a credit ranking for their actual credit profile. And then the REITs focus on that as a kind of a reason or rationale for how they say, this is the risk of our portfolio. This is, how our tenants are doing. And so we have a lot of investment grade tenants. We have X% of investment grade tenants. I think, for example, Realty Income boasts over 50% investment grade tenants. And ADC, Agree Realty, boasts, I think, like 60+%. They're the highest. And then you have Store Capital, which focused on the other end, non-investment grade tenants or unrated tenants. It doesn't necessarily mean it's bad. Unrated just means it's not rated. So, you are okay. Well, I don't post fake portfolios. In fact, the club members see the brokerage accounts and everything. So, but I'm not going to, let's say, entertain further, because it's like the club members are seeing you say it, but they at the same time see it themselves, the full brokerage statements, etc. But that's fine. There is no reason, let's say, if you were engaging with me in an employment opportunity, there would be a potential reason for me to show you my tax returns. But that's kind of an egregious ask, let's say. That's very personable ask. I don't see necessarily a rationale as to why I would engage in that, especially on a public forum. That's a bit childish. Fabio, post your social security number. Yeah, sure thing. Tax returns confirms brokerage statements. I mean, if the actual brokerage is not enough, then at least you have the timestamp of when I say an idea, the percent allocation, and you can laugh at me if I was wrong, or congratulate me if I was right. That doesn't defeat the whole point of it in the first place. I mean, the whole point of it in the first place is not even for people to engage in that. It's just the idea. So it actually does defeat the purpose if you're just kind of being anal about that per se. But hey. IRS tax statements. All right, so be like Capital Markets. I want to show your shoe shot. Yeah. All right, so anyways, going on to the Ozempic eats capitalism. Oh, all right, so the recent, I was kind of show some images, I guess, regarding the Ozempic news, because I found these interesting. And we'll go through, like, generally speaking, the bearish sentiment, which you can laugh at or, agree with, just depends on your perspective, is that Ozempic is going to drastically change consumer behavior. And you have the likes of Coca-Cola, Pepsi, Monster, all consumer staples kind of selling off. Again, I don't know the percentage that I would allocate to the reason as to the sell-off to Ozempic, but it's the fact that it's just making headlines or making people talk about it. We'll discuss it. So I'll entertain the idea from someone who actually shared some images that use the rationale of the Pareto's distribution to explain why it is more problematic than you might think. In summary, the Pareto's distribution is just a mathematical principle or observation that about the square root number of any thing that you look at is responsible for 50% plus of the outcome. So you look at a workforce, the square root number of the workers are responsible for 50% plus of the output of that work. And then, the same observation is done, I think it's like in galaxies, et cetera, for percentage of mass. But this same principle was applied by some people on Twitter. And then so you see Exhibit 11, 34% of the U.S. Candy consumption is in the top percentile or top group here. And then if you probably take over and you go a little bit deeper, the square root number responsible for a huge portion. So 34% are doing 9+ of the implication is that if this smaller group is their behaviors change, then you get a drastic change in the consumption rates overall. And you see the other large group, which is interesting, 34% consume 1 to 3. I don't know how much I consume. It's definitely, I don't even think I consume 1, but I probably am at a decimal figure for how much consumption there is. But yeah. And then let me see if there's any questions. Nothing's in candy this week. So one comment from the statements that would have definitely been found out, because they're the members of my community or the club are actually quite intelligent, and some of them their backgrounds are they are far more credible than what mine is. That is for sure. But yeah, if there was manipulation, definitely some of the more math inclined individuals would have caught on to that. Ozempic is so expensive. How could it impact candy sales? Well, you're saying that, Zastar, and I would agree with you. But it's something that's being discussed. So we're talking about it. That's the only thing. So I know it's expensive. I do know that. But we're ignoring that. I guess we're going to add that to where I agree with you, and those are the counterpoints. But we're all going to have the counterpoints to it. In summary, I don't agree with this narrative, but I'm just presenting it. And then another exhibit here is on alcohol drinks. So you can see that the top decile is responsible for a massive portion of the drinks that are consumed. Which, when I saw this, I was shocked. Again, I'm probably in the decimal figures. I think probably this is what measured over. Is it a week? I'm probably in between the 4th and the 5th decile. So yeah, because I don't really consume much alcohol. And then the top decile is just what mind boggles me. Like, that's wild that there are people that are drinking that much. And I'm assuming the images are representative of exactly kind of the proportion of alcohol. It's like a beer proportion, a wine bottle proportion, a martini proportion of alcohol. So let's see. Well, that's actually a funny statement. Lafufu knows more than Fabio. No, well, like, that could be completely true, by the way. I mean, if it's true, it's true. For me, it doesn't really matter so much as far as the discussions on YouTuber stocks. I'm just here for fun. Some people here are definitely here for their livelihoods. So, and that's completely fair. I'm not going to judge. If you're here for your livelihood, that's perfectly fine. Who is Lafufu? Yeah. All right, so next, and I'm just scrolling through just to see if there are any questions that come up. But yeah, Ozempic eats capitalism. I posted a meme on Twitter. I thought it was funny. And how it's like the dominoes are falling, and then eventually you get no, I don't follow Olaplex. So Olaplex was a case study that some of our members who worked. Well, I don't want to reveal that part, but let's say some members who worked in the adjacent entities that helped take it. Well, prior to help taking it public. Yeah, that's enough to say. We're discussing Olaplex as an example of when you can load up a company with tons of debt, acquire some other companies, make the growth numbers look nice and juicy, then you IPO it into the public. And so retail investors who are unsuspecting fall for it. And they buy it, and then you kind of get what you get. Olaplex is in an industry that's quite competitive. There's already a competing product that's supposedly cheaper and better. Olaplex was trying to that makes it sound like it's illegal actions, but they were on the surface, perhaps their financials looked better than what they would be in 30 months from then. So as we kind of see that growth basically fell off a cliff suddenly, that wasn't really nothing too surprising for some of you. But Fabio takes pictures of Target freezer section as due diligence. Yeah, that's the best way to do due diligence. You take pictures of freezers, and you see what is happening in your local store, and then you buy based off of that. Okay, so how much is Fabio's course? My course is roughly about $1 million, something like that. Where do I find his course? Where do you find my course? I don't know. I couldn't think of something creative to say that. But yeah, until the cost of each person's course, decide who the scammer is. But yeah, my course is about $1 million per week, because it's actually a subscription revenue service. Okay, is Dexcom a play banking on being an overreaction? That's maybe one that you could think of. Does your course increase in value? Lord Lethargy. Yeah, you could actually resell the course too. So I promise it increases in value, increases by about 10% per year, above inflation, 10% above inflation. Fabio, what is your capping on LMT America? I'm not capping on Lockheed Martin. It's just there's other defense contractors I think are more interesting right now. And I think Northrop Grumman's a little bit more focused and better positioned for this increase in space expenditure. But that's about it. But yeah, Dexcom, I think Dexcom fell a little bit. And you're pretty much relying on, let me see, put Dexcom. They have a lot of business in diabetic patients, and I should know this because one of my friends is type 1 diabetic. So if you think it's going to kind of maintain its very high multiple, sure. But the thing is, these are kinds of companies that I look at and I say, everything is priced into these names, and the story, as long as it maintains itself, it's going to keep its multiple. So companies that I've discussed in the past, like Hershey's, right? So I said Hershey's is priced for, its high multiples is telling you it's priced for a certain narrative. And any chink in that narrative is going to cause some in short term or maybe even long term underperformance. So Dexcom has benefited tremendously from their market share in the diabetic space. And it seems with the dietary habits of a lot of people around the world, and as countries become richer, it seems, unfortunately, that it's actually increasing. So the potential client base of Dexcom is also increasing, and that unfortunately is making it that they're benefiting, right? Their client base is growing, but that's not good for global health standards. Are you buying REITs? I've been buying REITs. The weighted I guess percentage of REITs right now is roughly, well, actually, because Meta, fortunately continues to rise, or tech continues to rise. It's roughly around the 10% mark. So, and in the holding co portfolio, it's really small, but it is growing. But I'm more focused on buying the really high quality REITs But in general, I maintain by my statement that 2023, it seems like it's a year to accumulate REITs. So that factor right now is performing poorly. And small cap as well is performing poorly. DXM, HSAs are a perfect match. Oh, yeah. Yeah, you play the candy side and then the diabetic side. Have you talked about BXP before? Yes, I have talked about BXP before under the context of Class A office REITs. There's KRC and BXP. Both are actually, good plays as far as the Class A office space goes. BXP is going to be geographically more diversified. KRC is going to have that exposure mainly towards California. So you get an extra discount in the KRC play because of that California exposure. So anything California bad, Boston Properties is geographically diversified, therefore it doesn't have that extra discount. There was sort of a play that I suggested for someone who wanted to still capture that and maybe let's say it was down on KRC. Talk to your local tax professional who handles your taxes, but this is like an idea that could be outlay. Like if I want office exposure and let's say I had already invested in KRC and you were down. And if I was down, I could say, okay, I want exposure to Class A office properties. I'll sell KRC for a loss, recognize that on my tax returns, and then you go into BXP, which is a different asset with the same kind of exposure. It's not as clear cut and dry, and this should not be. It's not as easy to put the correlation because these are individual stocks. So it's not the same thing as like, let's say you sell VU and you buy VTI, right? Because those are going to be more or less correlated. Or in some cases, like what we did in 2022 was with Naspers and Tencent. I don't know why I forgot Tencent. So we did that with Tencent. We bought the holding co instead. And actually there was a bit of outperformance there because the thesis was foreign companies or foreign entities were looked at poorly. Okay, so I'll tell you this because I'm going to share an opinion of a physician within the club. I'm just going to outlay that because I saw DaVita. They're not too excited, generally speaking, about DaVita as a business. As a whole, okay. I don't have their opinion on the other stuff. I'll say that Abbott Laboratories, among the physicians within the club, is actually looked at favorably. Was on their watch list, was on my watch list for a while, and has recently come down to where I'm actually interested in taking another look at it. Intuitive Surgical, don't have an opinion on, and then Insulet, no opinion on that one either. But DaVita was not liked by the physician community, so. I'll just leave it at that. But that's my quick and dirty opinions on those. ELS. Did you buy ELS? No, did not buy ELS. It's on my watch list, but I haven't bought ELS. Same with LVMH. At what price would PFE would become interesting? I can't answer it just like that. So what you kind of have to think about with when you ask about a pharmaceutical company is, okay, let's look at their pipeline. Do you have an opinion on their pipeline? I don't have an opinion on Pfizer's pipeline, so I can't make a judgment call on that. I would say that just looking at the current valuation on current existing earnings, it looks cheap, right? But that's the best I can do because an analysis on a pharmaceutical, I would be doing you a disservice saying you oh, it's cheap. Well, I don't know their pipeline, right? I have no idea. Same with Bristol Myers Squibb. Right now, Bristol Myers Squibb, let's take a look at BMY. We're getting a little ahead of the topics as we want to finish off Ozempic because I want to talk about the consumer staples and finalize those. But Bristol Myers Squibb looks cheap on the surface. What's the issue here, and I'll just not bury the lead here, is the Celgene acquisition, the pipeline isn't coming to fruition. It's not what they expected. If you go on YouTube, type in Celgene acquisition, Jim Cramer, and this was back in 2018 or so. For those of you who have been investing since then, might remember this. And he was really bullish on it. I'm not blaming him per se. I'm just talking about the narrative. It's not specific to Jim Cramer. The narrative around the Celgene acquisition was their oncology pipeline was very attractive. And as we move forward in time, we are in 2023, turns out, well, it's not as attractive as what might have been thought. And so you're going to see a lot of goodwill write-downs happen at the company. So non-cash expenses are going to rise, and the earnings per share subsequently are going to decline because of the non-cash expenses. They're going to recognize the loss. Grim Kramer crushed Bristol Myers. Yeah, he single-handedly did it. And current yield 4.04%, really high yield historically speaking. But I'm just illustrating as an example to your question, Bill E. If you don't have a judgment on the pipeline, it's not very, let's call it, not lucrative, but it's not very fruitful to make a valuation judgment, because you have to take the pipeline potential as part of your projections. And so that might require you to find a physician, someone who's more experienced in specifically what their pipeline entails, and ask them questions. That's honestly what I like about the club. I have access to people that have that real life in real world experience, and then I can ask them questions, learn more about certain things, and just, absorb it like a sponge. And sometimes they realize that they have, and this is not specific to physicians, this is specific to just people in general. Sometimes they realize by just saying, hey, you have an edge in this space because you work in that space. Most people do not. Most people don't know what you know. Why are you not focusing on finding companies within X space? And so actually one of the members, he actually has a YouTube channel as well. He works in the adjacent space for Arista Networks, right? Those of you who know. And I was like, why are you not hunting down for these opportunities? Why are you looking over here? You have a clear edge in understanding which companies are well positioned. What you do for a living, you know what systems are being used and what are not being used. Why would you not explore that further? And he is now, and I think he fully embraced that part. Of course, he looks at other things too, but I'm saying, sometimes people need that little jolt, friendly reminder from people around them. Say, hey, why aren't you doing that? But anyways, BMY has a solid pipeline, but low growth overall. They just did a $4 billion ASR last quarter. Okay, so Dark Knight. So you might have the opinion, you might have, I guess, real world experience and knowledge to say their pipeline is good. Okay, so now the next step, their pipeline is good. When is their pipeline going to be realized, and when are they going to get approval? What is the total addressable market? How much do you think they're going to capture in year 1, year 2, year 3 within those markets of that product? And then from there, you're starting to build out projections. And then you can kind of come to terms with what the current valuation more or less should be. So I haven't done that yet. Physicians are too busy taking care of patients to look at business plans. Yeah, generally speaking, they have some time. I've been actually privy to let in on some of the, I guess, discussion boards that they're on, and it's kind of funny some of the stocks that some of these physicians are invested in. Of course, not the physicians within the club. These physicians are in the chat rooms of other physicians that is dedicated to stocks, and it's really funny. They're not too different from like a Wall Street Bets chat room. I remember seeing one that was like, this guy was fully invested in GameStop, and this is like more recent chats, so it's kind of funny. You would think, but not really. Exactly what's their pipeline's total addressable market? Yeah, exactly. That would be like the question to start to build out. All right, but anyways, let's get back to the Ozempic issue. So I don't think Ozempic is going to be a longer term issue for consumer staples. So going from there, I think that I'm looking right now, and there's only one consumer staple that I've been buying. It was one of our analysts actually did the thesis on it, and I really like the thesis, so I actually took a position in it. But the overall, if we're looking at Coca-Cola, Pepsi, any of these names, you can make the argument that right now is an interesting time to accumulate some shares here. The valuation isn't bargain basement, but when are we ever going to really see bargain basement prices? I think something really bad would have to happen for us to ever see true bargain basement prices on some of these names. But are there other potentially better investments? Yeah, for sure. For sure. There's definitely better investments out there than these classical names, again, the Coca-Colas, et cetera, of the world. Clorox, another consumer staple that's not really food, has also come down quite a bit. I'll pull up CLX here. But here's a question of like low growth. So they're having a low growth issue. You could say Ozempic will help Pepsi because you can enjoy junk food and still lose weight. No. So this is actually something that is a misconception. And this is, again, thankfully, with discussions with physicians, et cetera, I'm just repeating information. But Ozempic isn't causing the weight loss. And it's causing a chemical reaction within your body that is making you, I forget the term, but it's making you lose your appetite. So essentially, it's like caffeine on steroids, because caffeine is something that actually helps suppress appetite. Thank you. Satiation. So it makes you less hungry. So you can't take Ozempic, go out and eat not thousands of burgers, but thousands of calories and just lose weight the next day. It's instead, you're going to take Ozempic. You're going to, and by the way, there's a big side effect. I would never take it. Again, there's perhaps reasons why you would take Ozempic, because maybe a condition, and listen to your doctor. I'm not going to give you medical advice, but from my understanding, as far as the side effects goes, you have potential paralysis of the stomach, which will be a long-term condition for a lot of people. And then you'll have to take other medications to help you with that. And current medications, again, just repeating information here, are not very effective. And so you will have a very miserable life if that happens to you. So nothing beats going to the gym and proper dieting. So if you do that, you'll be better off, right? Wow, that's actual advice. Diet properly, go to the gym, and you'll be better off. And then leave the Ozempics for well, unfortunately, Ozempic can be prescribed to certain kinds of patients. Let the doctors figure that out, the personal doctors of those people. But I would not take it to lose weight. No. That would be terrible. Just do drugs, kids. No, don't do drugs. Just obese people being lazy. I don't think Ozempic is really a game changer. I don't think so either. But I'm only entertaining it because that's what a lot of people are talking about. Okay? I'm only entertaining it. But yeah, so gastroparesis, I believe, is the name of the condition that is a side effect from Ozempic, or a common side effect. And it kind of makes sense if you think about the function that Ozempic is undertaking in your body. So you take it, you lose appetite. And so, well, it's kind of a poetic punishment for trying to take the easy way out. But yeah, just diet, exercise is tried and true way. Drink lots of water. Drink coffee if you want to suppress appetite. Drink tons of water if you want to suppress appetite. Hell, I mean, that's definitely medical advice. Drink lots of water. I can't go wrong with that. Also, Ozempic, good in kidney failure. Yeah. So that's what I'm saying. I'm trying not to do a broad brushstroke and say no one should take it. But from my understanding, again, repeating information from the physicians I've had conversations with, it's certain people, the physician will prescribe it to them for a specific condition that they have. Let that be the case. But if you're looking at it strictly from a dietary supplement to lose weight, I don't think that's going to be very conducive to a healthy lifestyle. In fact, I think it's going to be quite the opposite. You're going to cause more problems, go figure, and just diet and exercise. But will a lot of people take it? I don't think so, because someone in the comments addressed this. It's expensive. So if your insurance isn't going to cover it, are you going to really pay out of pocket to lose weight that easily? Maybe a lot of people will, and I'm very scared of that personally. Not from myself, but on a societal level, I'm just going to be quite surprised, because if we do cause a large portion of the population to have a condition like gastroparesis, I don't know if I'm pronouncing that properly, by the way, but gastroparesis, like paralyzation of the gastrointestinal area. Then, hey, what costs will that incur on the medical system? I don't know. Will there be a way to benefit from that? I don't know. I don't know any of these answers yet. So they stopped the study because it was too good. Interesting. So that's for kidney failure. Ozempic is not something that every obese individual automatically gets prescribed. This whole issue is hilarious. I agree with you. I agree with you. Okay, it's a funnel from Sweden for cheap. Yeah. Slurpees, you're hilarious. Slurpees, I can tell, by the way, from all your previous comments that you do like this sector, but that's a funny comment. I'll read it out loud. Gastroparesis can lead to weight loss, so Ozempic is working as intended. I guess technically, yeah, sure. Remember, they make addiction suppressing drugs, yet people still take hard drugs. British Warren Buffett here. Hey, how you doing, Warren Buffett? Okay, so in general, I agree with all of you in the comments. I'm kind of biased, but I agree with all of you who are saying this whole thing is entertaining to watch and is a joke, right? The fact that Ozempic is going to topple capitalism, the fact that Ozempic, that's more of an exaggerated joke, but the fact that Ozempic is actually going to change consumer behavior that much that all of these consumer staple stocks should fall so much. Is that an opportunity for you? I don't know, but just want to highlight it to you guys. If you guys think so, boom. I already commented on Pfizer. My commentary is that I can't give you an educated, like I would be doing you a disservice. I don't know if it's cheap. I have no idea. I don't know about their pipeline, so I can't tell you. If I had more information on that, I could tell you. But maybe that would be a discussion, I guess. I'll probably bring it up within the club, and as a community, we'll look into it. Because then I'll have the help of people, again, who can kind of look at that pipeline, give me an educated guess. We can make some assumptions, do some further analysis, and I can come back to you on that. Because I already know you're in the, at least in the free side of the club. It was one last thing to try before resorting to bariatric surgery. Yeah. That's another good point that, hey. But anyways, well, let's get into Dollar General. So Dollar General, one of the, actually by percent wise, I think the greatest percent failure of my holdings this year. For sure. All right. For sure. Actually, the one of the greatest percent failures this year. So what's the problem with Dollar General? Dollar General has a lot of issues going for it right now. It's like a perfect storm. So you have inflation, you have the consumer type, right? Let's start with inflation and consumer type because they're both related to each other. So the average customer of Dollar General makes about $40,000 per year. It's around that type. And if you take a look at, the consumer base, right? Again, $40,000 per year, and you look at the wage increases, they haven't kept up with inflation whatsoever. Usually lower skilled workers, and that in aggregate has been quite harmful to Dollar General, who, in theory, as a retailer, should be passing on prices on to the consumer. So increasing prices get increased for the consumer. Now, has Dollar General been able to do that? To an extent. And 2 earnings reports ago, they stated, we have reached our practical limit with our customer. Our customer can't... eu falo português também, Ketam Ramen. Because your question is, você fala português? Eu falo português. I'm actually learning my 4th language. So I'm working hard on getting conversational in my 4th language. That hopefully should be within a year or so. And then some of you who are in the club that speak German, I'm going to be using you as, você fala português? Eu tenho que falar português comigo. And sometimes I replace certain words because it's with Spanish, so there'll be like Portuñol occasionally. Anyways, sorry, you're distracting me. German, yes, German. No, that's the new language I'm learning. German, and then afterwards, I've been encouraged to learn Dutch. I'm trying to get to 7 by the time before I'm like 40. And then but Dutch would be a good segue from German, maybe. But I want to learn French. I want to learn French as well. And then one of the Oriental languages. I don't know, between Japanese, Korean, or Mandarin. I can speak some basic words in Mandarin. That's the one I know the most words in, is Mandarin over Japanese and Korean. Korean, I just know the I think the first 10 numbers, but that's about it. And then my Russian is ich bin ein Berliner. Oh yeah. So I know what that means. I'm already past that. So yeah, you're from Berlin. Oh. Ich bin ein ich bin ein wait, how do you say United States? I was just saying ich bin ein United States. Probably need some French. English next. Damn. Oh wow, you're dissing me there. You're basically saying I don't speak English. So yeah, ich trinke Kaffee. Right here. You see? Oh my gosh, how many Germans do we have? Wow, I didn't know we had so many Germans. Okay, well, yeah, I know that a good portion of the audience is global, but yeah. So give me like a year or so, and then some of you Germans, I'm gonna be engaging with you, trying to practice conversational German, because then when I go to the EU, when I go to Germany, I want to be able to, because I know most of them I can communicate in English, but I want to attempt to communicate in German. And conversational practice will help me with like the accent, the pronunciation of words, which if you guys don't know this, for those of you who are pursuing another language, I will tell you it gets easier the more languages you learn. So my brain seems to be grasping or picking up German faster than when I was going from English, Spanish to Portuguese. So English, Spanish, Portuguese, and then German, I can tell it's a little bit faster. And then I assume it gets even fast, not even faster, but marginally faster from there. It's easier. And I don't know what it's like to have only one language and learn the second, because I grew up knowing two. I'm fluent and idiot. You speak German in a Russian accent. Lol. Oh wow. Okay. Well, I didn't know that. Because I don't speak Russian, but that's funny. So when I go to Germany, they'll think I'm Russian. I am from Berlin. Yes, I got that. I already forgot my first language. All right. But anyways, so Dollar General. Sorry, I get distracted. I love interacting with all of you, but I get distracted, and then the stream gets to like 3 or 4 hours long. But Dollar General. Okay. So the current CEO changed. The old CEO comes back. Now, one of the things that we discussed within the club, this wasn't actually presented by myself, but one of our analysts, Leo. So Leo and Andrew, both of them stated it better than me, that they had a peacetime management team, and now they're entering a wartime management team. So just speaking on that, what's going on with Dollar General, because I didn't even finish that. So they have inflation, cost push inflation. They're not able to pass it on to the consumer. Their specific customer is tapped out. And so they're eating the rest. They're eating the cost up. Dollar General then from there is having shrinkage issues. What does that mean? Shrinkage issues. Theft is occurring at Dollar General. So that's costing them money on its own. And they're unable to maneuver around that. And I actually don't know how they're going to handle that, because it seems to be an issue across the board. The likes of Amazon might be one of the greatest beneficiaries of that, but Walmart seems to be handling it modestly well, or modestly better, but I don't really think that they're immune from it whatsoever. If I remember correctly, like if they hypothetically removed all shrinkage from their costs, I think their earnings would grow like 16-20%. So it's still significant. You have shrinkage across the board of retail. Like that's the current retail Armageddon going on. And by the way, if you're wondering, or if you haven't caught on, there's many different factors that are under pressure this year. So if you were outside of large cap tech, your portfolio has actually not done too well this year. And you include retail, regional banks. If you're a bank that's not JP Morgan, you have not done well this year. If you're just pretty much anything outside of large cap tech has not done really well. I mean, you look at Ulta Beauty. We'll come back to Dollar General, but I'm just illustrating like the point of retail. Ulta Beauty, All right. Oh wow, it broke 400 already. So Ulta Beauty on a downtrend. Year to date, down 20%. Home Depot, which is very powerful, very strong company, now has down 7.51%. But if you look at the recent drawdown, down 12%. Lowe's. Oh, that's not how you spell Lowe's. Lowe's. Yes, also Rise Aries, thank you. I was going to get to that, the increase in labor costs, but that goes along with the inflation narrative. So they can't pass on the price to consumers. All their costs are increasing. Their supplies are increasing, so like the cost of the products are increasing. While Dollar General has very strong negotiating power, their labor costs are increasing. Of course, the rents could be increasing, kind of in conjunction with what we were discussing earlier. But yeah, Lowe's company also kind of following in line with Home Depot. It's down 1.65%. The one retail stocks that have done really well, and if you haven't seen my episode with Chit Chat Money, shout out to Chit Chat Money. And J-Mac, I will answer your question because I see your question there. Me ruta también inglés, español y ahora portugués. Oh no, wait! I read your first sentence in a Portuguese. Mi ruta también inglés, español y ahora portugués. Okay, so yeah, you're learning that way. Yeah, no, that's the good way. And then from there, from Portuguese. Sorry, we're getting into another conversation. Get out of there. Okay, so well, I'll answer your question, J-Mac, in just a second. But actually, I'll answer it now, and then we'll come back to this because it's pertinent. So Amazon I'm not opposed to talking about changes in the holding co positions because the holding co is like my main focus. It's where the majority of my capital actually gets contributed to. Again, the members see the whole thing, the whole brokerage and everything. And even when they like see the dollar figures, like just so everyone knows, like that's actually pushing it to the limits. So that's right now the portfolio that's getting all of the attention as far as contributions go. And if you notice it, and for members who obviously see it, they've noticed that the allocation to Amazon has been increasing. So to answer your question and not go around it, it is being accumulated. Any weakness on Amazon has been bought up by myself. And of course, there's other positions that have also gotten some love, but Amazon's gotten the most love. And as far as capital allocation goes, right now, I think the capital contributed is greater inside of Amazon than it is in Meta in the holding co. But in my personal holdings, I don't think it's possible for me to get Amazon to the same level. It's not possible at this point. The only way that happens is if Meta crashes and Amazon rises, or I sell off Meta, which I don't really have plans on doing. But yeah, coming back to retail in general, or going back to the Dollar General question, the new CEO, it's causing the share price to rise, but it hasn't really changed anything regarding the narrative. But I am still interested in Dollar General. I'm just eyeing it. I sold it after the Michael Jordan of investing got really bullish on it. And because he doesn't miss like every single stock he likes, you should really question it. There's only one stock that I'm invested in that he also likes because I think, broken clock can be right twice a day. But yeah, I still saved a lot of money just following that principle of he likes it, I'm out. And I'm eyeing it because I do like the business of Dollar General overall. I just think, again, I maintain my opinion that there's going to be a lot of time for you to accumulate Dollar General. You don't have to rush into a company like Dollar General. But we'll see. We'll see. It might never end up getting back into Dollar General if other opportunities present themselves, but I don't want to not acknowledge the opportunity in Dollar General. That might exist. Okay, there's a question that came in. Do you think Visa at 24 forward PE is a good deal? I don't really know. Like I'm not really interested in Visa. I acknowledge Visa's market placement. We'll talk about that with Fintech. How about that? We'll talk about that one with Fintech. Because in the Fintech conversation, when it gets to PayPal, I'll be covering pretty much everything. Who is the Michael Jordan of investing? So there's a duo. Well, they're now a duo. They let go of the third guy, but Everything Money is the. No. Warren Buffett would never be put in that category. The Michael Jordan investing is way above them. Everything inherited. That's a good name for them. Isn't DG trying to increase the number of workers per store? That is their current strategy in an effort to try to mitigate theft or shrinkage. But I don't know if that's going to work. Like, I actually do not know. I don't know if anyone here has an idea. And genuine question for the community. I don't know what the solution really is to a decrease in shrinkage besides that. What are they going to do? Like tackle the thieves? Technology might help a lot, go a long way, but I don't know. I really don't know. There's not enough police to like go to every single retail store and just stand guard, but thoughts on Walgreens Boots Alliance? I'll talk about Walgreens Boots Alliance because that's actually pertinent to Dollar General and the other retailers. So Walgreens Boots Alliance, I think, has been a value trap. That's been my opinion for a while. And you had a lot of these other YouTubers discuss it. But I'm not going to just say that and not go further. I'll explain why it was a value trap, has been a value trap. So a lot of these larger YouTubers, they've been investing in Walgreens Boots Alliance. And it looked cheap on paper, but if you didn't look any further, you would have missed out on you would have made a grave error. So Walgreens Boots Alliance was more of an interesting play. And remember, we used to own Walgreens Boots Alliance. But it was an interesting play around here because it was a sentiment era. But the business was not something I wanted to hold long term. And if you recall, go to see where I sold Walgreens Boots Alliance. You can check out the links that are in the past trades tab. And I will discuss why I sold Walgreens Boots Alliance. So you have the timestamp and what the price it was when I even at least discussed it, and which was much higher from here. But the rationale behind not being long-term invested in Walgreens Boots Alliance was it was still a business in degrade. If you look at a lot of the operating margins, the gross profit margins, and you map it out across time, you see that they're getting pressured. Ignore the gross profit margins for a second, but just look at the operating margins. You can see a direct decline in the operating margins, and also kind of pretty much a direct correlation between that and the share price. So investors were eyeing that, and that's something that's plaguing both Walgreens and CVS. So it's not only Walgreens. Although CVS saw that coming, and what they did was they pivoted their business a lot faster than Walgreens did. So you have two companies here, CVS, Walgreens, pretty much the same thing as far as retail in the pharmaceutical space, right? They have their pharmacies and their stores, and then their pharmacies are placed at the back so that you go through the store because they want you to buy something from the store itself. CVS has been going the acquisition route, so they acquired Aetna, and with that, they are now also an insurance company. Walgreens is not doing that; they're doing partnership route, so because they also don't have the appetite to do those acquisitions. And right now, with their current market cap, their current cost of capital, I wouldn't really want them to do that anyways. Walgreens has very strong ownership percentage by an individual. It's this Italian billionaire guy. But that doesn't really mean much. If anything, he's actually stifled the prior changes that needed to be made. And the partnership route is a lot less risky than an acquisition route. But I think it's a little bit too late, or at least too early to tell if it's bearing fruit, at least in my opinion. Now, this is the cheapest that you've seen Walgreens in a long time. That dividend yield, 8.26%, is probably the reason why a lot of investors are really attracted to the company. Retail investors, unfortunately, because for whatever reason, dividends are the name of the game when you want to get traction on views, just because there's a lot of people that are really attracted to dividends. So each time the dividend gets higher and higher and higher, you think, how much higher can it go? Don't be surprised if that ends up getting cut, because the reality on the ground is they haven't fixed any of their issues. Their operating margins are still under pressure. The gross margins are still under pressure. They're dealing with the same issues regarding shrinkage, right? So all the same issues that are present in Dollar General are present here. They just have things on top of that. They have the actual threat of Amazon coming into their space. They have still a decent amount of leverage, even though they sold their stake, or they've been selling their stake in AmerisourceBergen, which AmerisourceBergen, great business. They are in a triopoly between McKesson, Cardinal Health, and then AmerisourceBergen. Cardinal Health was our former investment, but the AmerisourceBergen position that Walgreens had, I think that's like one of their good assets. They're selling it for a decent price, mind you. But that's more of a sign of weakness than anything else because they need the capital now to deleverage. So I'm frankly not interested in Walgreens Boots Alliance. I think there's much better longer term opportunities. Here you're kind of playing a turnaround story, and turnaround stories can be very dangerous because you're betting on management teams. What I would recommend you do if you're interested or investing in this, set out like a roadmap of what you want to see them do, and then start grading the management team on that roadmap that you set out. That's going to be personal to you. I'm not giving you a roadmap to lay out, but that's one way you can kind of go about this. And then decide for yourself if you want to invest during the execution of that roadmap at the beginning and then figure out if they're executing and then sell or add more, or just some mixture of the two, right? But you want to try to plan out how you would think Walgreens Boots Alliance should go about it, and then figure out from there, obviously, like how well are they executing on that strategy. Similar to what I've effectively done with Disney, I laid out 3 points in particular that I want them to execute on, and I will grade management team on those 3 points. And if they don't execute on those 3 points, then I'm not going to partake because I don't agree with them. I wouldn't agree with management. I don't want to invest in companies I don't agree with. So, let's see. Any questions here? Dollar General is not approaching. Let me see this because Dollar General question. Is Dollar General not approaching a ceiling on their growth? Yeah, no, they are. Absolutely. Well, management doesn't think so, but I don't know how they disagree with that, or how fake. I don't know if I can agree with that, is what I'm trying to say. Because Dollar General has, arguably, the business is definitely a different position than it was in after the Great Recession. But they claim, I forget the exact number they claim they can do, but it's something pretty crazy in terms of number of stores. I would just reference the primary documents from Dollar General itself. They tell you what their target goal is of stores, but they don't believe that they're near the limit. Considering there's a lot of still food deserts, et cetera, that they can probably capitalize on still. Hey, maybe that's the case. But that's the North American targets. I would tend to agree with you that they're approaching more the ceiling. So what you're getting at, or what you're kind of trying to get into Dollar General now, is such a valuation play, and then starting to just milk the business as it seems. So not so much a total growth story, which might deter some of you from investing in the first place. If they continue to increase store count, won't they be forcing to compete more with Walmart, Target, Costco? I don't think so. They won't ever be competitive against this because they're completely different. The other three that you're mentioning do compete against one another in some capacity, but I don't think Dollar General is ever going to necessarily compete against the likes of them. They want to always be in places where those guys are not servicing. That's the whole point of a Dollar General, the convenience of it. They're going to be in a place where there is no Walmart, there is no Costco very close by, and so you have Dollar General. You could argue the gas stations have done really well, like Musa, which, again, check out Chit Chat Money's YouTube channel for my conversation on Musa Murphy's. It's a company that we've been covering in the club for a while, and it's been a very good performer. And it's one of my top 5 holdings in the holding co. And so it's been one of the biggest ideas of 2023. Okay, so my gosh, we're starting to speak some Hebrew down there. No, I do not speak Hebrew. No, I have a friend that speaks Hebrew. They didn't raise their dividend this year. Give the thieves free that'll stop them. Yeah. Okay, so some conversation about Dollar General and Walgreens Boots Alliance. Do you see Dollar General's operating income recover back to levels seen before? Okay. I would, under a normalizing circumstance of, let's call it decline in theft and stabilization of price increases. So stabilization of inflation. And when I mean price increases, I mean also cost of labor. But, hey. That's kind of a stretch. But I think like the current price is really pricing a lot of different risks in. It could get better, it could get worse. I'll just go off of the methodology that the Michael Jordan of investing likes it, so I'll be cautious on it. And then there's other opportunities elsewhere. If Musa comes out and says no more stock buybacks for the next decade, does your yes, it does. Oh no, Andre, that's part of the thesis. Yes, so yeah, I don't know. That would be a game changer again because that's the whole point of it. All right, so now we're getting into fintech. I remembered all your questions. I remembered American Express was asked about. I remembered Visa was asked about. So we'll go in and we'll end off with like PayPal, the likes. Stock buybacks daily stock buybacks. That'd be wild. All right, let's start with Visa. So, by the way, after we're done with fintech, it's general Q&A. Let me go ahead and those of you who just joined, go ahead and answer the poll, and because I'm going to be ending the poll here soon. I got plenty of votes in here to kind of go off of. I'll give it, roughly 2 more minutes, and then I'll end the poll. So go ahead and have your thoughts shared. If you already answered the poll, ignore what I'm saying now. So Visa trading at roughly, I think it's like mid 20s, low mid 20s, forward multiples. Never have I seen Visa actually trade at a massive discount. I think the last time was, and when I say massive discount, I should be specific, relative to historical multiple standards. So was this time period. That was pretty much it. That was the only time I saw that. Visa, every single time up until then, was always trading at elevated multiples to market. Even then, that was still an elevated multiple to market. If you're wondering why that even is, let me introduce you to Visa. Hey, welcome to the world. This is Visa, one of the 2 major credit card networks that exist. This is not the credit card that you actually engage with, right? It's not the bank. They don't lend you any money. They don't charge you the interest. They are just the network that which you swipe the card from. So they're the rails, so to speak. And so if you look at their margins, their net margins are roughly 50%, which is crazy. MasterCard, roughly the same. And so you have 2 businesses that have incredible internal return metrics, incredible margins, and a massive moat where it doesn't seem anyone's going to come in to compete against them. So Visa here, trading at low 20s multiple, a forward multiple. And I'm going off of your comment, by the way, because Google here says 30.15, but I'll assume that it is 23 forward multiple. I would say there are probably for me other opportunities that I like more than Visa in the fintech space. And we're just talking about fintech. They're perhaps the idea I can get most behind defensively. I think that, for example, you have a company here that is very inflation resistant because they take just a percentage of the volume of the payment volume. So as long as payment volumes continue to increase and with inflation that increases, then you do have the prospects of a very defensible earnings position. So meaning that volume increases, the percent is flat, and then the nominal amount will just increase as well. But that's, again, assuming volume in totality is increasing. The only time where I would see this as a risk is during a large consumer recession, so decrease in spending. But the caveat to that is there is still the tailwind, which I think is slowing down because the adoption curve, we're nearing the end of moving from cash to digital, cash to card. So as that begins to continue along its life cycle, we're going to reach the maturity event, and then Visa's growth will simply be from practically only the volume growth in payments, and then the new adoption by, let's say, lesser developed countries as they begin to adopt the networks more and more. MasterCard, you didn't ask about MasterCard, but MasterCard kind of the same thing. So within the fintech space, these are the stories I can get behind the most. They're more understandable to me. However, I will say, same thing as I said with Hershey's, the narrative here is that they continue to have their duopoly. If that ever changes, you're going to see a drastic underperformance in this space because the multiple is only deserved as long as the narrative remains that there is no one that can disrupt them. And I don't know where technology is really going that I can confidently say that will never happen. I can't say that. I don't see it right now. Like, I don't see what the next thing is that would do it. So at present, I have no idea. But in the future, who knows, right? That who knows anything. So yeah, that's all. That's all I'll say. If anything, anytime you see historically that Visa has traded lower than its historical multiple, has been a buying opportunity to accumulate what is a fantastic business. This is no joke. This is a fantastic business, and you would pay, let's say, call it fair prices for a fantastic business. What is the likelihood? I think it outperforms at current prices. I can't say. I would say it's a different situation now than it was in late part of 2022, when a lot of these companies were severely underappreciated and there was all these, wild narratives that weren't business specific, just macro specific. Those were good buying opportunities. But any weakness, any big weakness you see on these payment processors has historically been a good time to buy. Forward projected earnings is more or less growing. I would say not the same levels. Like MasterCard, I believe, has higher forward growth projections than Visa. But Visa has the more attractive markets. They have a dominance in North America. MasterCard has more of a dominance in the Eurozone. MasterCard has a presence in some of the Asian nations that is larger than the likes of Visa. But just kind of also depends on your geographic profile. That will also dictate who's more exposed to cross-currency risk, etc. Okay. We will talk about American Express because I haven't got there. Historically, when Visa was cheap relative to itself, has been a good time to buy. Fabius. It's based on 2024 EPS. Okay, thank you, Dark Knight. So that was forward earnings. American Express is also a fintech. So we'll talk about American Express here because I said I would. And then we'll talk about the other fintechs. So American Express has their own network like Visa and MasterCard, except it's much smaller. So the circle of acceptance, or the range of acceptance, is going to be far reduced to Visa and MasterCard. They also are the more expensive. If you have a store, or you know someone who has a store, and you ask them how much does American Express charge you, you'll find out that American Express in totality costs more than a Visa and a MasterCard card for them to accept. But American Express has one of the more attractive clientele. So they argue to the merchants, hey, if you accept American Express, your payment or your sales volume will go up because our customers tend to spend more. Oh, and I'm going to end the poll here. So it appears that most people do not have the appetite right now for fintech. We have 70%. I don't know why it's putting 69, but 70% say no, and 30% said yes. Okay. So, Visa, very inexpensive service. Awesome. Thank you, Michael, because I know Michael here actually, you do actually accept payments. And so you probably know which one is cheaper or not. But yeah, Visa, MasterCard tend to be the cheaper options. American Express more expensive, but that's American Express's sales pitch to merchants. You accept American Express, you'll get higher sales volume because our clients spend more. American Express controls the whole stack. So they are the actual payment system. They are the bank extending you credit, right? Because that's a huge distinction. When you look at online, let's say on Twitter, and you see what people complain about credit card interest rates. And you're like, what the heck is going on? Credit card interest rates. And you're like, okay, well, you have a Visa card. It's charging 25%. It's not Visa. It's the bank. Visa is just the network that it's on, and they put the brand on it. And then a lot of customers blame Visa for credit card interest rates. American Express, that is them, right? Because they are the bank. But Visa is just the system by which the bank uses. And by the way, if you don't know the history of it, Visa was created inside of Bank of America, was a spinoff, and MasterCard was created by like a confederation of banks, and then was also spun out. MasterCard is kind of similar to like Zelle's creation, similar but not the same. So we'll talk about Discover because Discover will be included in this, but I don't really have good things to say necessarily about Discover all too much, but it is arguably like the cheapest. So American Express is the one that I hands down would buy. It would hold for pretty much my entire life. The reason why, the rationale is I can see, or I can argue that American Express is a company that cannot be disrupted in the same way that even a Visa, MasterCard, dare I say, could be disrupted. So Visa and MasterCard, for sure, I can foresee them being disrupted at some point in the future if things change. But I don't see what will cause that. Like, I have no idea. Okay. But they don't have the customer relationship that American Express does, or like the bank does. But getting back to American Express, the clientele that American Express has is among the highest quality. So within the banking sector, you have JP Morgan Chase, American Express. They're typically the top dogs. And like I said, when I talked about JP Morgan Chase at the beginning of this live stream, JP Morgan Chase is number one or number two in every business that they compete in. Every business they compete in, they're number one or number two. In the credit card space, they are still number one or number two. And what that means is they have one of the lowest charge-off rates. I believe they're projecting 2.5%. American Express is going to be somewhere along those lines as well. If not lower, if not a little bit higher. And we kind of can observe that American Express's clientele is going to be of that higher income, better credit rating. Many of you who are listening might have an American Express card, and you might have it for different reasons. I have American Express cards for the travel benefits they provide me. And you talk to American Express card holders, and they'll talk about the benefits they receive. Of course, some people sillily buy American Express. You should never do this, but buying an American Express card, any of the cards, and I say buy because they have annual fees, for the sheer flex, because no one actually cares if you have an American Express card or not. No one actually cares. But some people think that people care, but no one actually cares. In fact, it's nothing special. You should only get an American Express card. Of course, as an American Express, well, I'm not a shareholder yet, but as an American Express potential shareholder, no, absolutely. Buy it for the flex. People do care. People really care about what's in your wallet. And when you pull out that platinum card, people are going to be like, wow, you spend $700 a year on that card. You are now a better person. People will think that. As an American Express potential shareholder, I say that. But being real with you guys, no one actually cares. But millennials seem to want that card, even if they don't travel very much. And that's been really good for American Express because they get a lot of card holders that are paying a pretty high annual fee. And some of them don't even use a lot of the benefits properly. So American Express, oftentimes they get criticized for being a big, what's it called? A coupon book. That's what the American Express Platinum is often referred to as. So you get the waiver because of military. So if you're military, if you're active duty, doesn't apply to you. Because it's a free card. It's a free card, but I'll get all three Amex cards now. Because off the top of my head, the Amex Platinum is $695, the Gold is $250, and the Green is $150. So go figure how much that will be. So roughly $1,100 for like all the cards. Anyways, so American Express Platinum, for example, has a lot of benefits on it that are for some people quite difficult to use. And so what the business model entails is like American Express will go out and they'll pay in bulk for a lot of these perks. So they'll get discounts on it, and then they'll arbitrage that discount to the annual fee. And then on top of that, you use the card and they generate the fee off of the spend on it. So I'm going to make up a number, but I think it's like close to 5%. So every time you swipe the card, they're making like 5% on the transaction. That's not seen by you, that's seen by the merchant, but the merchant obviously passes that cost on to the customer. It's implied in the price of the product. And then with the charge cards, historically, in the past, you weren't allowed to carry balance. They've since then, I feel, in the effort to grow earnings per share and to grow in general, they've started to extend credit in the charge card space, which I don't know how I really feel about that. And that's before I was much more negative on it. Now I'm kind of neutral on it. And as long as they manage it well, in theory, it should be beneficial to the company. And in recent times, they've extended their portfolio and they've included a bunch of credit cards as well. So you don't only have charge cards anymore, you have credit cards in their portfolio. And so the difference between a charge card and a credit card is whether or not you can carry balance. Now the charge cards, you can carry balance. I forget what the interest rates are, but there's something along those lines. They do charge something. It used to be regular in the UK, the American Express sign at shops when I was still young, don't know why. Oh, yeah. Well, young still don't know why. No. The reason why is because it's much more expensive. It's much more expensive to accept American Express. And American Express was the fledgling network that was trying to get out there and grow. And so since then, in the UK and in parts of Europe, is now much more widely accepted. Last time I was in the EU, the American Express was accepted almost anywhere I went. It was hard to find a place that didn't. Yes, thank you. That's actually the flex, the invitation only black card. Okay, that's the actual only flex. And I think the annual fee is like $5,000. I personally do not have it. But that's the actual only flex of an American Express card, because it's invite only. By the way, the way to get it is you have your platinum. If you spend a lot on your platinum, like a lot, I forget what it is on an annual basis, but it's like most people's salaries. If you spend that on the card, you'll get in the letter the invitation to receive the black card. But that shouldn't be your objective. Your objective actually should be to save as much money as possible. A lot of people, it's a lot easier to get the business black card. The business black card is way easier to get because you think about it, you expense a lot of your business expenses through the Amex Platinum. And before you know it, you've spent hundreds of thousands of dollars on day-to-day business operations on the card, and there you go. You get your invitation, and you can get it. But yeah, so it's like $200K. Okay, yeah, it's something. It's well over most people's salaries that you have to spend on the platinum in order to get invited to the black card. Then there's the JP Morgan, I forget what they call it now, but the JP Morgan card, which I think is 10 million in assets. So it's actually probably more, not fruitful or beneficial, but like less, again, because your goal should be to save, but if you happen to spend that much for whatever reason, you get invited. But with JP Morgan, it's about saving up to 10 million, then you're good to go. The JP Morgan Reserve, thank you. And that's another like flex card because it's hard to get, right? But a lot of Americans, or not a lot of people in general, they like to flex like the platinum card. Like for example, when I see someone at a restaurant pay with the platinum card, I think one of two things. The first question is they might be getting their annual bonus, or they might be getting that sign-up bonus, and that's like okay. But the other option or possibility is that they're trying to show people, for whatever reason, this is the first time they have a metal card or an Amex Platinum, they're trying to show people they have the Amex Platinum, because it's one of the worst cards you can use to pay for food. It's actually probably the worst card. Like the gold, sure, the gold is 4 points per dollar on spend on food, but the platinum's 1. There's no reason to use the platinum on food. No reason. In fact, most of the things that platinum is good for is stuff that you would pay for online and you never even take out of your wallet, which is 5x points back when you purchase directly from the airline. Has to be directly from the airline, or on American Express's website. And then I believe it's 5x points on hotels only through American Express's website, not even directly to the hotel. So like look at those two categories and you're like, when would I pull out my wallet and take out the card? You don't, right? You don't. So yeah. Anyways, enough about the credit card products per se, because we can nerd out about that if we want, but I don't use my credit card. It's my emergency fund. I will talk about that very briefly right now. What that person's financial advice was to use a credit card in lieu of an emergency fund. Absurd. If you're near my age, younger than me, older than me, it doesn't matter how old you are, really, do not do that. Because here's the thing. I was going to make a video, but frankly, because of my time these days, but my time is more liberated recently, but my time these days, I haven't been able to make much public content. So the main issue that he doesn't understand, because this is how you know when someone has not been responsible for their own finances, right? They have no accountability of their own finances because they're literally supported by family, right? This is how you know if someone says something like that, because here's the thing. So the statistic that they use for the unemployment rate being at 3% is implying that you are 3% likely to be unemployed, and that's like a fixed percentage over your life. But it doesn't actually reflect the reality. The reality is that at some point in one's life, you might be a part of that 3 to 5%, whatever the range is. And during that point, if you don't have an emergency fund, you're going to have to use your credit card. If you ruin your credit like that, there's a bunch of consequences that will last you a long time. It won't just stop there. if you guys have never rented before, forget buying, because you already know, you probably already know logically, I ruined my credit, and now I can't get a mortgage. Okay, so you can't buy. Okay. Well, let me pause by saying probably the only person who wouldn't be affected by this is someone who owns or already has their mortgage, owns all their stuff outright, is not planning to buy a car within like the next 7 or so years. Because again, you're going to ruin your credit for at least 7 years in the United States before you can ask them to remove some of that from the point of default. But if you're a renter, this causes problems for you because now you have to renew a lease. You have to maybe find a new place on an annual basis. Who knows how often you move from that lease? But the problem is now your credit is ruined. You think the landlord doesn't run your credit? I mean, that's someone who has never rented before, and so they obviously don't have that experience. But if you ruin your credit, right? Well, okay, now you might not. You now are affecting your living situation. You're also going to be affecting your ability to get other forms of credit, like good luck buying a car at a reasonable rate, right? Especially where rates are now. But I'm saying when rates were low, if you had bad credit, you were getting a 7%er, which today is the good credit, right? But now if you have bad credit and you're trying to get a car, I don't know what the rates are, frankly. No idea. But yeah, if you have good credit right now, you'll get like a 7%. And maybe in some deals, I know that like Subaru was running a deal. If you had good credit, you could have gotten like a 3%. Some of my friends hopped on that because they got their Subaru WRXs and BRZs. But anyways, imagine not buying a used car. Well, yeah, it's the fun. Negative 200 isn't fun credit score. Well, you can't get negative 200. I don't know about the UK because you're maybe talking about a UK. But what about having a watch collection instead of an emergency fund? No. So also with watches, that actually defeats the whole purpose. And that's how you know the difference between like an actual watch guy and a non-watch guy. I am a watch guy. I don't discuss the watches here. You might have seen it on occasion, me wearing a watch, but I don't like make a point of making videos about it or anything like that. But the point of being a watch guy is actually the love of the watch itself, and you're not supposed to buy it as an investment per se. That's not the point of the watch. And so, in fact, if you're doing it for an investment, I would metaphorically slap you. I would metaphorically slap you because there's so much better ways to actually participate in an investment, such as investing in an index fund. And that should be utmost your priority. Because actually, just like the credit card thing, no one actually gives a damn about what watch you're wearing. Like no one actually cares. The people who wear the watch for other people's amusement are the people you don't really want to hang around in the first place. So if you care what another person is wearing as a watch, that's your problem. And I frankly wouldn't want to be associated with you. But there are people that are like that. And they're kind of obnoxious, and usually they're like new money people because class I don't think is about money, by the way. So we're getting into that conversation. Class is not about money. It's about how you carry yourself. So you can have a little bit of money but have good class. And so someone who cares if what someone else is wearing on their wrist, besides from the appreciation of the piece itself, right? Because there are people who do, but they don't judge the person. It's about the appreciation of the piece itself. So it's like I have a friend who's a watchmaker. Some of you kind of know him because he talks sometimes in the club. And he will care about what you're wearing on your wrist, but for the appreciation of the piece itself, not for how much it costs. It's not really about that. There's actually in the watch community, in the true watch community, there's appreciation of Casios. Okay, Casios are looked upon favorably, not unfavorably. Yes, it's a cheap because it's not about the money. And so that individual said, you have to buy a nice watch that's over a certain price threshold. Immediately when he said the price threshold, I immediately threw it as he's one of those people that collects the watches and actually looks at it from the point of valuation, from the value of the watch. And that's how he'll judge almost like the quality, the branding. He cares a lot about the brand for the brand's sake, not for the history. And that's a big distinction. It's an important distinction. Because the appreciation for Rolex is not for Rolex's sake. It's for what Rolex represents, the history of Rolex. Same with Tudor, same with Omega, same with Audemars Piguet, same with Constantine's, same with any of the legacy brands, right? And then there's within the watch community, there's like the people who love. I'm sorry if I offend anyone. People who love Hublot, owned by LVMH, by the way. And yeah, they are considered the people that just want to buy the expensive watch. So anyways, enough of the rants, because you guys brought me into that conversation because that individual said no emergency fund and buy watches, etc. The love for watches is meant to be the appreciation of the piece, not an investment. Never do that as an investment. I will metaphorically slap all of you if you come to me and say, I bought this because it's an investment. It should be like secondary to why you bought the watch. You should have bought the watch because you enjoy the watch, you enjoy the piece, you have fun wearing it, not because how you think other people look at you, but because how it makes you feel. And that's it. And that's all that should matter. Okay, and yeah, I've had this conversation with you, or Kale, last night in the voice chat. I remember we talked about the Apple Watch being an ultimate. I wear Apple Watch most of the time. It's an ultimate utility watch in terms of keeping track of calories, telling the time. Honestly, who cares about anything else? What discount rate do you use for a Rolex watch in DCF? I use a 50% discount rate. All right. But watches don't lose value. Actually, most watches lose value. Some watches don't lose value, but most watches lose value. All right. So summarizing, let's finish off with discussing more of the fintechs here, because barring any other, I see. Cole, you called me. Why'd you call me, Cole? Call me again if you actually want to say something to me. Yeah. And then, Dan, I just saw your message about Ozempic. I bought a nice watch, so I won't be able. Oh, Cole's calling me. Hold on. Cole.
Yeah, I wanted to tell you that watches appreciate faster than stocks do.
Okay, cool. All right, I'll talk to you later. Bye. He wanted to tell all of you that watches appreciate faster than stocks. That's all he wanted to say. Thank you, Cole, for your insight and contribution. All right, but finishing off, American Express, probably the only fintech I'd say I could buy for an entire generation and be comfortable with it lasting. I know, LOL, Cole. Patrick, I think you were the one who asked in the club. Someone asked me in the club about watching LVMH. I'm watching LVMH. I think a lot of us are watching LVMH. And some members who own LVMH are still quite happy with the performance it's had over the past couple of years. That a monster company. I see Paul launching. Yeah. Anyway, so going to some of the other fintech plays, let's talk about PayPal, the big boy in the room that retail talks about. So PayPal has a lot going for it. They have the new CEO, which is looked at optimistically because he has a lot of really good experience coming from Intuit. And Intuit's a company that, most of us probably, if you run a small business, are familiar with their products, QuickBooks, TurboTax. You might have used TurboTax in the past, and a bunch of other software solutions that they have. But I think the one that people most think of with Intuit is Intuit QuickBooks, which is very good for small, medium-sized businesses, more leaning on the small side. And the benefit of coming from that background is, you have somewhat of a tech background, and PayPal is fintech. And Intuit's not too dissimilar, right, from what it's an adjacent industry. It's not directly competing against PayPal at all, but it's adjacent. I think with Credit Karma, which Intuit also acquired, they have some adjacent competing products. Credit Karma has a high yield savings account, is trying to compete in some ways as being a financial service hub for some consumer needs, but for the most part, they're not really competing. Although the experience, I think, will be quite useful. And his age is referenced as one of the reasons as to people being excited, because he's a young guy, the previous CEO, an older guy. This guy can bring fresh ideas, hopefully reignite growth. But PayPal does have a lot of growth inside of it. People are just not, well, they are talking about it. I won't say they're not. Retail is talking about it, and that's Braintree. Braintree is the main source of all growth at PayPal. And that's perhaps the only exciting business right now that PayPal has. So the thesis outlined is quite simple, right? You have legacy PayPal, which maybe we can even bring up their earnings slide presentation. So we have another visualization to go off of. But with PayPal, and give me a second to bring this up. I'll have it up in no time. Going through the website. All right, we'll use the Let me quickly go here. Give me just a second, everyone, to pull this up. This is a problem about, doing live streams. I love live streams, though. They're very fun. Ba-ba-ba. Okay, so the August 2nd, 2023, right here. All right, so I'll kind of go through, and let me come back here so I can see your questions. Did you buy Adyen? No, I didn't buy Adyen, but there is someone within the club that did buy Adyen. And they did a nice write-up on it. I'm actually going through the write-up as we speak because the write-up was, as they say it, their magnum opus. And they're discussing why it's a potential opportunity. But I'll get to that in a second because Adyen will be discussed. PayPal, I'm dead. Dan loves PayPal, by the way. Dan, this is his favorite stock. So I talked a lot about this on an update a while ago with PayPal, but here I'll talk about some of it here today. The KKR news is actually more optimistic than what I think people believe. And that's actually coming from the standpoint they are able to monetize their buy now, pay later, which they're exiting. I'm happy they're exiting. I don't think they should be in there because that's getting kind of more to a quasi bank. But the sale to KKR signal to the market that they have the ability to liquidate this portfolio and get actual value, hard cash from it. Now, let me get to this is the total payment volume, which again was still increasing, which is positive. But the total payment volume, the problem with this metric is it's also taking into account the Braintree growth, which I'll get to in just a second because I'm trying to find the slide where they have, but I don't know if they highlight it entirely. Guidance drawing, non-transaction expense declined. I want to see continued operating margin expansion. Gap operating margin. I want to see their take rate because their take rate's the highlight that I want to showcase for a reason. Let me see if they just stay it in here. Hold on, give me a second. Take. Okay, there we go. So I was looking for this. Now we see transaction take rate was down 11 bips versus Q2 2022. Approximately 2/3 of the decline driven by FX fees, lower gains from FX hedges. And this is the part, they say 2/3 of the decline was driven by lower FX fees. Lower gains from FX hedges, lapping elevated contractual compensation from merchants from last year. And then the remainder of it is coming from the growth happening in Braintree, which is inherently a lower take rate business. So if we look at the take rate from something like a Braintree, I don't know what exact figure is, but if it's comparable to something like a Stripe, it's like 2.5%, something pretty low, if not lower, total potential take rate. And depending on the agreements they have with each client, it could be lower. And Braintree right now is in a customer acquisition phase. What that means is that they're just basically discounting their services. If bringing Adyen into the conversation, Adyen talked about the recent gains that Braintree has made, and without really mentioning Braintree, just simply that a competitor was offering their services for a discount and taking market share, and so that's what's responsible primarily for the decline in growth in North America. Adyen has spoken, or the management team has talked about how they are not going to decrease their take rate in an effort to compete just yet. Now, if that changes in the future, that would be very negative for the stock because that's basically management admitting they're wrong. And that would probably be a point in time of loss in confidence in management. The market would not take that well. But that also goes against the narrative of that it is a race to the bottom, which if Adyen is correct, because Adyen argues their product is superior to Braintree because of the, I forget the term they use, but it's like the approval rates for Braintree. And the approval rates for Braintree, I don't know what the statistic is, but Adyen says theirs is the highest in the industry. Let's take their word exactly as they say for now. We have no reason to think that they're lying. That being said, if this is wrong and Braintree is eating their lunch, and not only that is comparable enough that merchants will actually take that lower price, we could see actually a decline in customer base at Adyen and an increase in Braintree. And it furthers the narrative that this industry is a race to the bottom. PayPal can afford to have a discount offering on Braintree because they have the remainder of PayPal within their business. So legacy PayPal, what you see when you go on a website and you're like pay with PayPal, that's their legacy business. That's their branded products. And then you have unbranded products with Braintree. So the branded products is subsidizing the unbranded right now. And what could be exciting about PayPal is that now they're saying we're going to go into Europe. Right now we're good with North America. We're getting market share in North America. Braintree is going to Europe, which is Adyen's playground, right? That's Adyen's backyard. Adyen is a European company. It's one of the tech darlings of the EU, and which they don't have many to begin with. But it's one of, I think now after the recent cut, it's down to like a $23 billion market cap. Still sizable business, but it was much larger before by market cap measure. So it's yet to be seen. That could be quite negative for Adyen. And so my opinion on Adyen kind of remains as like, I'll watch it, but we could see a further decline in growth in the European market from Adyen, and that could give us even better opportunity. I don't know. We will find out shortly within the next couple quarters or so, within the next year for sure. And that could be beneficial to PayPal. So I get the bullish narrative of PayPal. The bullish narrative is simply legacy business will keep chugging along. Total payment volume will continue to increase. We saw that in the chart. Where was it? The total revenue is connected to total transaction volume. So cross-border TPV, active accounts, and TPA. Wait, no, we want to go to total payment volume, which is here. So if this continues to increase, we're in good shape. The active accounts decline isn't too much of a issue. Where's the active accounts? So the active accounts decline is an issue on the surface, but if you consider that total payment volume continues to increase, that's actually the more important metric. Total active accounts, it is and is not an issue. From management's description of events, they are doing less promotional activity. And so that's the reason for the decline in total active accounts. And you don't want to focus on the low quality customer. Low quality customer is the customer that will only use a product when there's a discount involved. Companies that know the value of the product don't have to discount their product. And this is also if you remember when we brought on the fund managers, Chit Chat Money of Arch Capital, they discussed their thesis around Sprouts Farmers Market. One of the things they pointed out, which is connected to this, is the thesis change, or their bullish thesis began once they saw the strategic shift in management from going from the discount customer, so issuing coupons, to reducing that and focusing on the core quality customer that doesn't need the coupon to shop there, that wants to spend money and is willing to spend money at their stores without the discount. In your marketing class, you might remember, for those of you who studied, any form of went to business school in general, one of the things you discuss in your basic marketing class, which everyone has to take, whether you're finance, accounting, or any other major, you learn the case study, or your MBA, by the way, your MBA class. One of them might go over this as well. We'll go over the case study of oh my gosh, how would I forget them? Kmart. I almost forgot them. Kmart. So Kmart is the classical example of discount galore, always issuing the little coupons, and then they have this client base that's pretty low quality, all things considered. And then your margins are terrible, deterioration of margins, and you think you're getting market share, you're growing sales volume, but you're not actually growing earnings. Sales volume can only take you so far before earnings become a problem. So that's the main issue, and that's a benefit to PayPal. So that was a good move. I'm going to praise them for that. So I have a lot to praise PayPal for. Okay, now why do I not like it? And if you remember my older videos, I had criticisms of the valuations that larger YouTubers were making, and people forgot that they even made the valuations. I guess people just move on from it, but the valuations were absolutely absurd. And do they have a decent moat, SH? Well, I'll discuss that in a second, because that's actually what we've all been talking about, which is it's seemingly a race to the bottom. So that implies very little moat. Seemingly, and I keep using the word seemingly. I'm trying to be cautious with that because it's not a guarantee. So the PayPal's valuation, from my analysis, has been constantly actually being adjusted downward ahead of time, not upward. We maintained the below 70 for a while, and this was, again, when PayPal was over $100 a share. When I did the videos where I was reacting to other content creators' analysis, I had already stated my opinion on the valuation of PayPal. And when it got to 70, I understand why, because I had that, valuation on PayPal. I got a lot of requests, a flood of requests. Hey, can you review PayPal again? Because it had approached 70. And then upon that, my opinion kind of remains the same. It is cheap on the surface, but there's a lot of issues now with the forward projected growth potential. And so that has actually decreased the valuation. I think the current fair value valuation is like low 60s. Last time I checked. But then again, we get more updates. It either increases or decreases based on the current reality. But it is cheap. That no hands, no ifs, ands, or buts about that. It's just now it's competing against other opportunities I see on the market. And just the very fact, and I saw someone commented on this, that the Michael Jordan of Investing also really likes. Michael Jordan Investing recently posted a video, "We are buying the stock now, PayPal future multi-bagger." So that already tells me I should be questioning everything about PayPal. Just on the methodology of using that guy as a counter signal, question everything. He is literally the type of guy that you say short everything that man touches. PayPal, if we don't make money, nobody makes money. PayPal trash. But yeah, the moat is questionable. Is questionable at best. Some argue that the branded side has a moat on virtue of simply being, a name that people trust. Okay, but I don't know exactly how true that is. Paul is the new Jim Cramer. Potentially the new Jim Cramer. I have no idea. Potentially. But if I look at the other landscape, there, like American Express, I would argue has the highest moat and probably not the fastest growth. It's a fairly mature company. They will grow as long as like the upper middle class grows. They'll continue to grow globally. And as the world becomes more economically developed, they'll continue to benefit from that. I can't say PayPal would be a generational hold. I can't see that. I could see an argument from people saying that PayPal is a trade. Sentiment is definitely negative in the fintech space. We'll also talk about some other fintechs that get talked a lot about retail. And I'll actually open the line for requests within the fintech space if you want me to discuss it, because there's so many names. But again, we've already talked about the payment processors. We talked about Visa, MasterCard, American Express. Some of these banks that are fintech. I'll talk about the other retail one that I've spoken about previously in the past, SoFi. BTI is a multi-bagger. We can talk briefly about BTI, but we'll be closing off here soon because we're already past the 2-hour mark. Small craver. Oh, that's funny. All right, so let's quickly talk about the other retail favorite, and we'll talk about SoFi briefly. The one SPAC from Chamath Palihapitiya that is the one that's probably surviving the best. GPN. So the thing with GPN, FIS, etc., they're decently high quality businesses, but they're all having a situation where their moat is under question, and the growth is under question as well. So FIS, GPN, the only one that's kind of maintained itself because of, I believe it's due to its software relationships with the banks, which is a very sticky business, is Fiserv, FISV. But FIS, GPN, and the like, FIS has the acquisition issues that they Empire built, and they're kind of admitting that they did that with WorldPay. They're spinning that out. You have GPN though, which is good quality management, seemingly more prudent acquisitions across time, and just the space in general is frankly troubled. They don't have the diversified business or secured business in what Fiserv has, like software with banks, the back end systems for banks. They're simply the more so in the payments infrastructure, but. Oh Lord, the companies are getting worse. Yeah, we're getting into worse and worse companies. SoFi's the best fintech on God. Yeah. By the way, if you have liked this live stream so far, feel free to leave a like and then comment afterwards. But feel free to leave a like. It lets me know that you guys enjoy these live streams, and then I'll do them more. I do in general enjoy doing these live streams because again, it gives you guys the opportunities to, ask me things live, confront me live, do whatever you want live. And it's kind of a different form of what we do in the club, which is like the voice call hangouts, etc., where you can even speak live, and then we have a conversation that way. But I do in general just enjoy doing live events with you guys. It's fun. All right, but SoFi Technologies. Let's talk about some of the issues regarding SoFi Technologies. So, issue number one: it's liked by retail. No, I'm kidding. That's a joke. Just because it's liked by retail doesn't mean it's bad. But SoFi Technologies has had a very troubled upbringing, let's call it, since its IPO, since it SPAC'd out. One, it did SPAC, and there's a negative connotation around SPACs. That is true. Two, by the way, I will separate the banking product, which, by the way, fun fact, I have recommended to people, okay? I recommend SoFi as a banking product to beginners. What do I mean by beginners? Do I mean beginner like, no, I mean beginner by, income net worth. I do not believe SoFi is the best bank you can use once your net worth rises into the tens of thousands or hundreds of thousands or millions of dollars. I think there are far better banks. In fact, I'll shout out a bank right now. I believe the best bank for a individual person, right, is if you have anywhere from 20,000 to the several millions of dollars, will be Bank of America. And then if you have tens of millions, the benefits start to not get the best. And then if you have millions upon millions upon millions of dollars, you can even I would recommend even diversifying across banks to get multiple relationships. But I'm talking within the big banks here. JP Morgan has also a very, very good private client solution. Like their private banking solutions are really good. You can get a lot of value out of that. But if you're looking at a beginner bank, SoFi is really good. And that is for anyone who has a net worth of under, liquid, let me rephrase that. Liquid net worth, so not including your house, including cash, stocks, etc. Liquid net worth of under $20,000. If you are under that threshold, SoFi is a great bank. You get no fees, high interest rate, decently high interest rate, which, by the way, let me just caveat that by saying you can get that in a money market account. Much better interest rate, about 0.5% more, roughly speaking. But if you are looking at it from a product, I like to think I'm objective. I'm not going to sit here and say that's a crap product. No, it's a good product for the beginner. And I've already defined beginner for you. As soon as you start to get into the tens of thousands of liquid net worth, I think there are better banks. I think there are better products for you out there that you'll be able to build different relationships with. I think, for example, if you're looking at the best big bank after you pass, 20, 50, 100,000, that's Bank of America for sure. Bank of America, because you get a bunch of benefits on the credit cards part, you get a bunch of benefits on transaction fees going away, and they have a very robust network. You have good, I believe, client relations. And then they have even now a new tier they just actually created, which I think is attractive in and of itself, above the $1 million mark and the $10 million mark. And then afterwards, there's no point in putting more money in there. But and they also have very high interest rate products, which those of you in the club know about the cash account. And so about the high interest rate product that Merrill offers. We have people who work at the bank within the club, and I jokingly say to them, why am I not getting my affiliate link? I bring so many clients to you guys. But yeah, good customer base, me. Yeah, there's a little bias there, a little bit biased. But but going back to it, so SoFi, good product for beginner. They have a lot of customizability, like where you can put your savings account with, and you can separate into multiple savings accounts, like I think they call like buckets, automated buckets, which I think is really cool. It's a gimmick, but it's cool, and it helps out that beginner person, because that beginner person, let's think about the situation they might be in. They might be saving up for a house, a car, they might be paying off credit card debt. And so kind of being able to segue cash off every paycheck, so it's set it, forget it, might be good for them. because some people don't have the constraint to, not spend money in one account. So they have to almost like separate it away from their checking account. They have those solutions for you. So as a product, that's good. But there's a lot of banks that do that. But I'm just trying to come out of the gate with an optimistic view on the product before I begin to say some of the problems. Okay. So saving for a watch. Alec Beach. Nothing material has really changed in the portfolio updates. But since you ask, this is not an official portfolio update, but that's the whole point of these live streams. You can actually ask live. I will say that like on public on YouTube, the updates don't happen as frequently. And that's by virtue of not having the time as of late until recently to publish public content. But that being said, when you ask a question like that, I'm more than happy to give you highlights or let's call it footnotes about changes. Essentially, the biggest change has been the Dollar General position. That's about it. That is about it. And that's already happened a while ago. But nothing really material has happened. The allocations, there has been some small buys, but again, nothing material. Really, this cash position is roughly the same. And if you guys are wondering, the cash position is still roughly around 27% as updated on Twitter. So yeah, it's still a good amount of firepower. But yeah, good question. Saving up for an Amex Black Card. That's not saving up for a watch, maybe. Saving for a watch. Anyways, so now what are the problems with SoFi? SoFi, let's start off with the business products that they offer. So SoFi offers a lot of personal loans, it's personal loan products and student loan products. I should also mention me and Dan, or Dan and I, to be grammatically correct. Oh, okay. Well, there's a question. Hold on. I'll get to this question first. But before I get to the Dan and I, what's 20K get you at B of A besides D's, of course? Okay. So what 20K at Bank of America gets you is now you enter the threshold of the gold status with Bank of America, which gives you a 25% boost on your credit cards, plus discounts on on interest rates, both in the mortgage and car lending. And when you increase it to 50K, and by the way, you already get no fees on any accounts. I actually recommend you don't have a Bank of America account until you pass the 20K threshold. That is when you open a Bank of America account. I do not recommend Bank of America until you pass $20,000 in liquid net worth. I recommend you use another bank. And I'm just being honest. Bank of America does not need your money. That's kind of the attitude you get out of the biggest banks. They don't need your money. They don't offer these nice no fee accounts. They only want you if you have a liquid net worth above a certain threshold, then they'll start offering you things. So I highly recommend, until you save up 20,000 liquid net worth in the United States, because I don't know outside anything, then get a Bank of America account. But let me say 20,000 liquid net worth available to deposit at Bank of America in a Merrill product. So you have, I don't know, your Roth IRA with them, or you have whatever, just 20,000 in net worth with Bank of America will get you that status. I don't think they're worth it until then. I think you're better off with going with other banks. And then from there, up to the 100,000. Once you get to 100,000, it's 75% bonus on credit cards. So actually, if you're a credit card fiend and you're looking for the highest cashback credit cards ever, you have the 2.65% cashback on the everyday spend, basically on the all category, unlimited of that. And then you get 5.25% cashback on the categories, which include dining, travel, etc. So it becomes like the best credit card setup in the game when you're looking at pure cashback. If you're trying to be one of those points optimizers that it's really meticulous, you can get a lot more return on spend. But if you're just simple and you want no annual fee cashback, Bank of America is the best end game bank. Do you publish your stock positions? Yes, I do. So there's a distinction. The personal holdings are kept private from the dollar figures. I provide to you allocations as well as the actual verbal updates, discussions, etc. Live streams. They're typically done on live streams for you to ask me questions. This, however, and under discussion with members of the club in the past, I actually might end up, sort of quasi-retiring. And the holding co will not be the same kind of decision of retirement. And let me explain what that means. Well, there's been really good fortunes in the personal holdings as a whole under my own investments. And so the decision is being contemplated whether or not to just simply sell off and liquidate the positions over time and just go into a broadly diversified index fund. And then the holding co, which is updated in the club, only in the club. But if I'm being honest, the modern or the current strategies are the same, because why would they be different? That would make no sense. That's updated via screenshots of the brokerage and everything, brokerage statements in the club. And essentially I provide I put a monthly contribution into that account, and I try to be long only, as in I try to actually have a 0% cash allocation in that account and strictly buy stocks. And then I have the cash business investment account as well. That's strictly just cash, but it's not really like firepower cash. It's just savings cash. So those are updated as well. And I try to update in materials of or intervals of materiality and public on YouTube. On the club, I update probably a lot more frequently. And again, there's both discussion component and updates, like actual updates component. Do I reveal the dollar value in the club? I reveal the holding co value in the club, but not. Okay. But let me start by saying this. I would encourage you that if you're joining the club for the purpose of seeing a portfolio, it is not to copy the portfolio. You do see the dollar figure. The dollar figure should not be a illustration of me being right or wrong. I want all members to be judging it on the idea, and there will be times where I am wrong. And we have a lot of members who even have larger portfolios than what you'll see. I don't know exactly the values, but I can tell by just conversations I'm having with them that, roughly speaking, you can kind of piece together that their portfolios are very large. And the point is you judge it on the idea and merits. So some people can, and this is one of the main principal reasons why I never even showed the dollar figures publicly on YouTube. And in fact, when I first showed the dollar figure in the club, a lot of club members remembered this philosophy and pushed back. Some of you who are watching remember this because you guys said maybe you should not show it. Because it sways people into making judgments off of whether you're right or wrong based off of the dollar figures. And that's the marketing tactic a lot of people on YouTube will do. I'll show a very large portfolio, and now you're like, you're right because you're smart because it's a very, very big number. But it's not necessarily the case, right? So judge it on the ideas in isolation, and feel free to question my investments. Actually, you'll do me a service if you find a defect in my investment thesis. You'll do me an actual monetary service, and and pay attention to what other members say. And over time, I hope you develop a strategy. That's not a message to you specifically, but a message to everyone who is in the club or thinking about joining the club. It's meant for you to become an independent thinker, not for you to be a follower. By the way, and there's not just myself. I'm not the only contributor. As we kind of evolve as a club, because that's what it is, it's a club, I am but a mere public face of the club. That's all I am, and that's what I'm becoming. There are people in there who contribute very good ideas that are not myself, right? And I don't claim their ideas. I like to always give people, well, everyone knows where the ideas come from, because I never want a cult of personality. And I think members also will police each other in the club on that, which I like. So, but yes, that is revealed in the club. Do you have a dividend portfolio for passive income? I have a very immaterial dividend portfolio that I update. It has $1,000 in it. It's extremely immaterial. It's for fun. I made it as a joke on M1 Finance. But yeah, it's updated in a very irregular, infrequent basis because don't move it, don't touch it. And I made it as a joke in discussion with some of the members. And it's on M1 Finance, which is funnier. If you drop under 20K, they throw things at you. You have about 3 months. It's a 3-month average. Hello world. Yes, that's the current price. The price increased because we brought on a lot of other contributors, and so in an effort to make sure everything's compensated, there's also a software that's being developed. It's not the same kind of software that you might think of, like Everything Monies and all that. It's an actual. Well, I won't talk about it too much because it's not my place to talk about it. Do you share your past performance yearly? Not even yearly. I share it as far as like you can see it regarding. Well, when I say yearly, I assume you mean posting it on a yearly basis. No, it's posted more frequently than that. And yeah, it is typically compared to the S&P 500. I've compared it to the NASDAQ as well, because the NASDAQ is at this time maybe more. Not prevalent, but because the exposure in the portfolio is also highly concentrated in tech, like the personal holdings is about 70% tech, and the holding co is roughly around the same. I think probably a little bit less. It's another index that I'll compare it to. I've done so in the past. Are you beating the S&P? Yeah, presently I'm beating the S&P. I'm beating the S&P in 20. Well, so the holding co began in 2021. It's a bit misleading for 2021, but that's why you use the brokerage's calculations on a dollar weighted basis. So on a dollar weighted basis, which is going to be more accurate, you could say, because the contributions happen monthly, and so in the very beginning of the portfolio, the contributions were like a huge portion of the increase. So you do a dollar weighted gains calculation, and so the 2021, and that's the standard brokerage form of calculating it, by the way, if just stating it out there. But in 2021, I don't remember what it was, but that's the year it started. I believe it was like somewhat in line. And then 2022, we outperformed. I posted it on Twitter if you're curious. But again, it's posted also in the club. So 2022, there was this very strong outperformance. I think we eked out something like along the lines of, oh gosh, I forget if it's what percentage it was, but in line of the market, like the market was negative, we were quite positive. And then 2023 shift, where I think roughly 50-60% gains. S&P is 10%, and NASDAQ is, I forget what the NASDAQ is. Let me check NASDAQ real quick. 38%. Okay, so we're still above NASDAQ. But yeah, that's it. All right, so reading some more questions. GLW, I'll get to GLW. But I hope I answered your question on the yearly thing. I don't post it yearly. But if your question is, do you post it by year? Yes. I post it much more frequently than yearly, just not by year. And the concept of the retirement is more so been flirted around when I went on Jesse's podcast months ago now, because I get asked that a lot. Do you think about de-risking the portfolio a bit? And yeah, I think I'm thinking strongly about doing that, and then focusing entirely on the holding co port as far as my like individual stock investments, and then kind of just in a way literally retiring. But then still having my individual investments via an entity, and then kind of going from there, building that track record consistently over time. But anyways, do you refer to yourself as the face, not the brain? No. Okay. So because I will say it, and I'm no shame in saying it. I am definitely by far not the most intelligent person in that club. There are people whose like intelligence levels are insane. Okay. Like as in, I'd say I'm lucky that they're in the club. They're not lucky that I have a club. I'm lucky that they're in the club. And so I find it as a value add for myself in that capacity too. And even like the analysts themselves, they have pretty incredible backgrounds in and of itself. So I definitely would say now, I cannot claim to be the brain. I cannot claim to be the brain. That would be both very cocky, and improper and incorrect. Just generally wrong. Just generally wrong. I attempt to be contributive. I have the, I guess, desire and courage to go in front of you guys and just talk and have fun. And I have fun doing this. That was always what YouTube was meant to be. This is fun. But there are members in the club, and I see like some of you members who are currently members, you guys can talk about it. Speak for, don't let me speak on your behalf. Be honest. When, in terms of what the intellect level of some of these members are, it's absolutely insane. Like I could never claim to be the, Dex Invectus. So yeah, we call them year-to-date bros. People who only show the year-to-date performance. So keep an eye out for them, because they use it as a marketing. Again, because I understand this is like their living. YouTube is their living. They make money off of this. This is how they make all their money. And so it's all about marketing yourself to the people. And so you'll maybe change how you look at the portfolio. You'll ignore 2022, where maybe you underperformed. You were negative 50%, and now you're up hundreds of percent, or 100%, or 50, 60%. And okay, well, let's look back a little bit. You asked them, hey, how'd you do in 2022? Show me your 2022, etc. Best performance capital mindset member and percentage is Fuhat. Yeah, I know you're joking. 100% you're joking there. The pit provides the most value. Jesus Christ. Oh yeah, J. Yeah. You sent me that video. I just feel even dumber. Yeah. No, it genuinely is. I'm very proud of the members more than anything, and so that's honestly why at the same time I do mostly private content. I focus most of my time on private content. How many members? I think there's like close to 500 members, and we will be introducing, like, we'll be getting back to kind of like the freemium version of the club, but that will come back with interviews. So like we'll do interview only, and then you still don't get like the full access, but you get like the freemium access. We're contemplating on how to implement that, but there'll be some sort of interview process again, which I liked in the past. It makes it so that the membership joining is like of the caliber of personality we want. Improved capital mindset member Bacon by default. Most improved. Yeah. Well, yeah, there's also that. There's the amount of people that have at least stated that they've, become better investors over time. Because there's also an academic side. We also have a few people that focus more on the academic side of investing. So you'll see them reference various research papers, et cetera, and they'll have various discussions around that. There's been a recent interest in factor investing as a strategy, understandably so, and a big focal point of the community, at least some members. There's also different debates and discussion about dividends irrelevancy theory that often is misrepresented, both misrepresented in the pro and the contra arguments. In the pro arguments, often, dividend, we won't get into that because we'll make it too long, but there's some people who make then conclusions based off of dividend irrelevancy theory that are incorrect, but then there's some people that argue against it, making straw man arguments against the argument itself. Sorry, but we won't want to nerd out on that. So, no, he's not in the club. No, Dark Knight. No. I do notice when it's not like we're well, I won't say that. Okay, well, finishing off with Fintech, and then I'll open up to Q&A. I don't really have an interest right now in any fintech name per se. I acknowledge some of them are cheap. I already said my point about Adyen. Want to be a little bit more patient with that one, see kind of how management, how right they are. But of course, I'm willing to give up some of the gain if we see some price appreciation. Again, I acknowledge they're all cheap. If something does materially change, that would, in fact, when I say materially change, sentiment just shift, because I understand the sentiment's really negative around fintech. You throw a rock, hit a fintech stock, it's probably down. If you're not Visa, MasterCard. And the companies I'd really be more comfortable owning over a very long period of time is American Express, but I don't expect like a ton of returns from American Express. Let me be clear on that. It's just more of a, if I had to invest in one of these companies and hold it for 100 years, it'd probably be American Express. And that's saying something, because I don't think of many companies I'd be comfortable holding with 100 years. Big tech is encroaching in the fintech space because it's almost like a natural evolution for these companies to go. At least fintechs talk over REITs. Yes. So REITs has been a conversation of this year quite a bit. The Warrior. Hey, Capital Mindset. How you doing, The Warrior? Okay, so after that conclusion, I'll open it up to questions. Any question goes. You can ask any question, which we've already been kind of addressing questions. And I've been addressing like miscellaneous questions here and there. So any question that you guys might have, I will begin to answer as they come in. If not, we will end it here. Oh, Investco. Okay, we'll look at Investco. WhatsApp is the future, bro. Oh yeah, WhatsApp. I'll mention or talk about WhatsApp. I'll count that as a question. And wait, let me put up IVZ here. Okay, so IVZ, Investco. Now with Investco, I think BlackRock reported earnings here on Friday. Let me see what kind of the growth projections are for Investco, because I think I think negative projections on Investco are mapped out. You have a dividend. Okay, so maybe that's why people are interested. 6.07. I'm not saying that's why you're interested, but might be why it's bringing up. But yeah, so Investco here. What's your natural hair color? So I don't know what this is. Different people say different things. Some people say this is dirty blonde. I call this brown hair. My natural hair color is brown, but I have like blonde in me. So like my arm hairs are blonde. So then I have like blondish hairs. But anyways, going back to Investco. Let me. I'm gonna map it out with BLK, because BlackRock also reported earnings here, and I'm pretty sure they had like a decline in inflows. Hold on, let me do compared to, and I wanted to show their, we'll remove their long-term performance. Wait, hold on. Let me quickly just do this. So the performance of the stock has not been very good. All right, but let's come here and put up the 5-year. Yeah, this is what I suspected. BlackRock has been really dominating. And in this business, it's all about scale. So BlackRock's been just eating up the industry. Them and Vanguard. Vanguard's not public trade. It's a nonprofit. Long-term quarterly net inflows. I think they had, yeah, it was like a huge slowdown because they had 80 billion in Q2 and they went down to about 3 billion. They had about net outflows, reflecting, they had about 50 billion, I think, in outflows, something like that. And then I think ETFs was like a strong point. They had like 30-ish billion, and again, like 50 billion the prior quarter because it was still the strong one. Bearish Investco because the name is stupid. I have SH's question just came in. By the way, it helps a lot if you put at Capital Mindset. Hello world, your recent comment, I saw it. You didn't at me, but I saw it. Yes, that is a great way to think about it because it's true. And a lot of people forget that. PE is history. Exactly. That's looking in the past, and that's a problem. You got to be careful. Okay, so I'm trying to come up here to all the questions, but Investco, I prefer BlackRock. That's quick. Look at Investco. Because the thing is, in the asset management space, in particular, creating these index products, I believe the best players, the top players, are going to continue. It's going to continue to consolidate and concentrate into the top players. So BlackRock and Fuhat would be so happy me saying that. Fuhat's going to be so happy. Going down the questions, I already answered the hair color. Do you have any members of seven-figure stock portfolios? I don't know precisely, and I don't ask. I feel like, personally, I look at it as a irrelevant question because I don't value them more or value them less based off of their portfolio size. I know that for some of their professions, some of them are likely to have seven-figure portfolios. And the way they speak sometimes, I can tell that they may or may not have portfolios in that range. But I don't ask. It's on a don't ask, don't tell basis. Or tell if you want to, but I think most members across the income bracket, generally speaking, thankfully do not mind or care. It's more so about, do you present a solid idea? If you can have $1,000 portfolio, you give me an idea that's good, I'll take a listen. You have $1 million portfolio, you give me a crap idea, I'll tell you it's a crap idea. Can you please talk about the credit rating agencies and which is better, SPGI or MCO and payment processing company? Which one is better, V or MA? Completely different flavors across the board. SPGI and MCO don't have a preference. I'd argue SPGI has a bit more diversified revenue streams. MCO trades at a much higher premium. Could be looked at as like there's again a reason for that, but. I'd almost lean on SPGI at current valuations, but that's very surface level opinion. Processing companies, I'd take, well, depends. You want higher growth prospects, greater risk, MasterCard. You want greater stability, dominance in North America, but still some growth aspects, Visa. Both are solid, just different flavors of how you want to play on a global landscape. MasterCard, more international, Visa, more North America. Done. Thoughts on OZK, Bank of Ozark, just quick thoughts. They've managed their book quite well, their inflows quite well, outflows quite well. They focus on their exposure to commercial development is what's under question right now. Although the regions that they focus on, I think that they still have really strong long-term tailwinds. The rising rate environment is a problem for them, so keep an eye out them. Keep a watch list eye out for them on when rates start to decline. I think that lending volume can start to increase meaningfully. But I haven't looked at them in a while. I have no idea how they're doing. So that's just like my just surface level thoughts on the general business, like what I would expect from them. Okay, so let's see here. Fabio, how was your day? It was very good so far. Very good so far. Any thoughts on TLT? TLT, you're gonna have to be right on the macro, and not so much on the timing. So it's not as bad as like a TMF product, but you're gonna have to be right on like the macro trajectory. So definitely, like the only play is like long-term rates will come down, which that's kind of what the bond market is saying. But you're gonna have to be timing that. Otherwise, it's gonna be dead money. I can point out to you. Let me point out to you some role models you can look at on YouTube that have been saying it's been a buy for like years, and they've missed out on all the gains in the stock market. And then maybe they're gonna make some money on TLT. But when you average that out over the years they've been invested in TLT, it wasn't worth it. And that's like Stephen Van Meter and the likes of them. I'm not dissing them. I'm just illustrating like how you can be right on an idea at some point in the future, but the timing of these investments is what matters. So I can't comment on the timing because that would imply that I have some sort of understanding or knowledge of the broader macro outcomes. That's like if anyone tells you they have that understanding, yeah, I don't know about that, but. I can't say that I know exactly when rates are going to come down. No idea. But yeah, they're going to be a good play to play rates coming down. What field of finance you work in? Well, technically right now I don't work in any field of finance, but right now I am rolling over into a new very interesting opportunity, and so it's more of a managerial role. But yeah. Price of sales is useless. Revenue can be about 100 billion. Cash flow can be 5 million. Absolutely. Agree with that. Love that. Free cash flow is the best measurement. It can be, depending on the business. So I'll counter you, hello world. Some business types are a bit more difficult to value on a free cash flow measure. I would generally agree with you, though. Generally agree with you. I have 10 figures. Michael might have 10 figures. That is very true. Okay. PE is history. Thank you for the response. 5 Kevin mindset. That was straightforward. I have a similar thesis. Yeah, no. I think that's a common thesis. Will you do a macro stream at some point in the future? I'm going to try to do more streams now that recently I have more time. But yeah, recently I feel like I'd have more time. BlackRock is winning. I said BlackRock over Invesco. So no, I know BlackRock is winning, but I chose BlackRock over Invesco. There's Fuhat. Whitestone is a strong buy. Let me see Whitestone. I don't know Whitestone. I've never seen this company. Whitestone. Nothing. Didn't come up. So never mind. In general, you with cash flow, ROIC, well, return on invested capital is an internal return metric. And then cash flow is just it's a measure of profitability. So both, but ROIC I think is important. I feel like you would make a good investment banker. I don't think I would want to do the hours per se, but I've been trying to round out my experiential background to eventually accumulate a level of skills of an idea I want to do in the future. I won't discuss that further, but basically all the jobs I've done now have been to accumulate some experience in some avenues for my future goal. But investment banking, we have some investment bankers in the club, and some of them complain about their hours. Hey, it can be lucrative. You can make hundreds of thousands of dollars for sure, and if you stay really, really long time and make it, you can make in the millions for sure. But there's a lot of ways to make money. Okay. Whitestone is what some finance YouTubers smoke. That's funny. And that's a funny name as well, Jihad Jerome. As a generalist, how do you feel comfortable with going into stocks like INTC or banks? I ask because I often get cold feet since I don't have the industry-specific knowledge. That's a great question, Paulo. So one of the main benefits, so you could be a generalist, right? You can understand from a financial perspective when something is of value, but you're right. Like, how do you get that extra edge? Well, that's what I think the value of having a community is really comes in handy. So being part of a community that has all these backgrounds, people who work in the industry, you have access to consult with people who can give you their 2 cents. And they say, okay, well, I'm a semiconductor engineer. I can help you understand what are the different distinctions between business A and business B? Why is business A doing things that are better from an operational standpoint than business B? Why is business A's invention better than business B's? How is business A's pipeline doing? How's business B's pipeline doing? And the like. So that's how I can help get comfortable. Like, there's a company that I still haven't gotten comfortable with that I'm invested in, but it's on a smaller scale, and that's Shockwave Medical. First time I'm mentioning it on publicly on YouTube. So I have a position in Shockwave Medical, and it's one that I'm in current discusussions here and there whenever I get the opportunity with those who are much more familiar with the studies that link its products to being game changing, quote unquote. But I don't pretend to say I myself am the expert. And it's still one that hasn't grown into a size where I'd argue that I'm super confident in it. It's just getting there. And by the way, that's a position in the holding co, not the personal holdings. So this is not the Sunday call. So Aramas, don't worry. This is not the Sunday call. The Sunday call, well, it's not happening on Sunday, but it's going to happen later this week. The weekly call. This is not the weekly call. Timing is critical. I started when the S&P one was 1,200. At that time, everyone was scared. Think the market was really expensive at this time. Absolutely. So that's like, you're going off of like a broader, index strategy approach, and you're looking at it from forward earning estimates of the S&P, current valuation of the S&P, which is actually not done on a weighted average PE. I have a video on this, but the mathematical calculations of PE is not how you actually think. It's on a weighted harmonic average, not a weighted average. Important distinction. RMS, every time there's public content, it doesn't count as the private content. So they're completely separate. I had to make that distinction earlier to people. But yeah, when you see public content, that doesn't count as a replacement for private content. Thoughts on cybersecurity. So full disclosure, I'm invested in Crowd, not the other three. But and if they benefit from the war talk. Okay, but you're looking at different benefits of the players. I'm not entirely sure where Zscaler fits. I haven't done enough research on Zscaler. So I'll kind of put Zscaler to the side and say I've heard mixed feelings about it because I myself don't have an opinion. But CrowdStrike is my investment. Palo Alto is another best of breed stock, but they don't compete well. They're more of a complement to CrowdStrike. CrowdStrike is the best endpoint cloud-based solution. So benefit of being cloud-based, they have very fast delivery rates. So, they can be protecting your network. We have people who work within the cybersecurity space who can explain this a lot better than I can. But essentially, CrowdStrike is considered across the industry professionals as best of breed, the best at delivering or providing the product, very quick delivery time, and switching costs, but the importance of endpoint security is becoming more and more and more prevalent. I can highlight to you the recent hack at MGM that further illustrates a reason why companies need more endpoint security solutions, because at MGM you had not so much a problem with the digital stack, but you had a problem with the human error. So it was human error the reason why people were able to access it. And so that is an endpoint security solution offering right there that could be fixed in the future. So making sure that that's a little bit tighter. And also desegregating. This is a common thing you do in audit controls, for example, desegregation of decisions as far as like security or digital security. So you don't want one account to be hacked and then they have access to everything. That's a common thing they audit for as far as when you judging for security. But yeah, Crowd is giving away. Yeah, so that's the counter argument to Crowd. The counter to Crowd are like the not the bearish, because it's nothing to do with the business operations. It's just to do with the how they treat owners in a way. Is they pay a lot of money via stock-based comp, so it's not cash, it's ownership, to the employees via stock-based comp. And I think that's not too much of an issue, strictly because that's how they're attracting the best talent. And so it has to be judged individually. Like if you look at Fortinet, I had a bet with someone. I won't say their name. I don't want to be mean anymore. But Fortinet versus CrowdStrike. And there was like CrowdStrike, if you look at the year to date and even the 1 year, right? The 1 year, you can see that CrowdStrike for a while was underperforming Fortinet. Fortinet was the buyback story. CrowdStrike was the diluter. Fortinet was still growing pretty well. But recently there's been a deviation, and that started after this recent drop here because basically growth slowed. The projections on forward growth slowed at Fortinet. I think that the thesis is simply that CrowdStrike being the best of breed has, again, the easiest deployment of their product being cloud-based and has therefore less friction, is going to begin to take more and more market share in the endpoint solution space. And so Fortinet having a weaker product, weaker solution presently, that could change, who knows, means that, that they're going to have to basically compete on price. And so that's how, companies like Checkpoint even survive. They just offer you like the cheapest offering possible. If you guys don't know Checkpoint Solutions, I have a video on Checkpoint, but it's not really, hold on, Checkpoint Software Solutions. Israeli company, by the way. Or at least I think they're based out of Israel. Yeah, Tel Aviv. So cybersecurity company hasn't grown at all. If you look at their revenue growth, it's been pretty much like nothing. Fabio's skipping another call. No, not skipping another call. We're doing the call. What time is the call? I don't know, but it'll be sometime this week. I was sick of this guy. Big pharma show. Look at Berkshire stocks, no stock-based compensation. That's the old American way. Yeah. I mean, I'll say that I would prefer companies that don't do egregious stock-based comp as a percentage of revenue or income, et cetera. I prefer businesses to be GAAP net income profitable, which accounts for stock-based comp. In general, I agree with you. I very much agree with you. I just apply a more nuanced approach to it. So CrowdStrike is not my biggest holding, although I kind of wish it was a bigger holding for now. That could change because of its recent performance. But I don't immediately deny a business's place into my portfolio strictly on a stock-based compensation policy. Checkpoint Software Solutions. I only brought them up because I wanted to show a company that hasn't grown at all and has been a lot less volatile, by the way. So I think my video was like end of 2021, and I said that they were a better opportunity than CrowdStrike and Palo Alto and all them. It was a video where I talked about all the cybersecurity stocks. And they're like the value company here. Yes. I have a conversation or videos talking about stock-based compensation being an actual cost. Yes, it is an actual cost. In fact, you could argue it's more costly than people realize because ownership or equity cost is more expensive than cash cost, because cash is cash as has a time value decay in the future, but it has no forward value, right? No forward increase in value. Well, the equity presumably has a forward increase in value. Therefore, you can calculate some form of dirty way of saying there's a forward cost profile to it. So, I would rather, if I was a business owner, I'd rather give you cash as a form of, expensing rather than giving you my equity if I believe the equity is going to be much more valuable in the future. I absolutely agree with you. I do agree with you. And you should not ignore it. So no one, if you feel like I was saying to ignore it, or if anyone feels like I'm saying I'm ignoring it, I'm not trying to ignore it. I'm not ignoring it. I do account for stock-based comp in my valuations. I account for share dilution in my valuations. Energy. Okay, yeah, we'll have a conversation about energy. Because why not? So stock-based compensation actual cost. Hold on, I didn't mean to. Wait, did you repeat your question down here? Okay, just making sure you repeat your question because I saw your question. I was going to scroll back up to it, the warrior. All right, so you did repeat the question, so I'll just answer the question here. What do you think about dividend or dividend growth ETFs such as DGRO, VIG, or SCHD? Every YouTuber is making videos, and it's not good. Yeah, I know. Yeah, we joke about it in the club all the time. And in generally speaking, if you put a gun to my head, I feel like the strategy of DGRO will be the best over a long period of time because of the targeted companies it does. But I'm not too much of a fan of overcomplicating ETF or index strategy. So actually I was in a conversation with a friend of mine he works in the tech space and he makes a very good income, but was questioning if you're watching this, I'm not going to say your name, don't worry. But he makes a very good income. And it's like, okay, what do I do with it? I asked him the question, like, do you care about individual stock investing? Like, do you want to do any research or do you want to kind of just set it, forget it? Set it, forget it was his answer. So very simple, one fund at a time, and that's it. I'm a big believer in that, just picking one fund and then never looking at it again. So long story short, my opinion on them is I believe that they are overcomplicating the strategy of if you're just trying to be a passive investor. The reason for that is most people who are involved in these strategies are doing it for the wrong reasons. They are chasing performance. The vast majority of retail investors on YouTube chase performance. I think everyone here knows that. Everyone watching me knows that. Most YouTube people chase performance. They'll talk about a stock if it's up a lot, And some of them kind of try to take that philosophy, flip it on its head in the dumbest way possible. I say that as respectfully as I can, where they start to just buy things when they go down. And they say it's cheaper, it went down, I buy more, I buy the dip. That I think is the wrong approach as well. So buying stock just because it goes up, buying stock just because it goes down, both are, should be questioned, not just accepted. So DGRO, SCHD, those are very popular. And we recently had a discussion in, I forget where it was, I think it was the Strongman live stream. Why are so many Canadian dividend investors, why are there so many of them? Like, why? I don't understand that. It's kind of like you throw a rock at a Canadian investor and it's a dividend investor and they're like 25% banks, 30% energy. And it's Canadian banks. It's wild. It's weird. Do you think you can time the market in the well, let me get to that question because that's a good question. But we'll get to that in a second. Just don't want to skip people's questions here going through. Okay, Energy XLE. Brief opinion here. So Energy had a recent spike this year, but XLE, you're talking about the actual companies. So the companies could, in theory, benefit from a prolonged increase in energy prices, which I have new news to color that point. Today in the club, I made not an announcement, but a text write-up, not a write-up, that's the wrong word because it's not like an essay, just a commentary that with the current red line that Iran has drawn on the Israeli invasion, which is likely to happen, that could pose a threat to, a threat to the supply chain of energy, and that could increase energy prices in the short term. So it might be just interesting to start thinking about that, if that is something that's possible and how that would reflect in energy prices and by extension energy stocks. So just put a pin on that. That's something I'm going to be exploring over the next couple weeks. And not saying I'm going to act on it, just think about it and just try to strategize or plan out a scenario in which that occurs and how I would position myself. Okay, so going through, let me see if oil versus like the comparison. Trying to see if there's any questions. When you sleep, we eat. Buy the dip, don't buy the trip. Is that actually a statement by that person? Wow, that's funny. Okay, do you think you can time the market in the short term? Getting to this question from Hello World. Although sometimes I might feel the need to attempt to, or feel like I can, I don't think. I think it's very difficult, and so I try not to even bother. I just try to find assets that individually I think are attractive on their own face and accumulate them, and that's pretty much always been my strategy. I will make commentary, share my opinions, but that's all they're worth. They're just opinions. They're not based off of something that even I necessarily will follow through on. It's like having a conversation with another person, and that's how I kind of treat it. So I might have like, I have this opinion about what's going to happen in the macro view in the next 6 months. And I'll talk about it with you and we'll have a conversation about it. But that doesn't mean I'm going to go, like, I might say, I'm unsure about the market in the next 6 months. I'm unsure about the US economy over the next 6 months. But that doesn't mean I'm going to go out tomorrow and sell all my stocks. It'll just be like that, like engaging in the conversation. More often than not, I just stick to my strategy. That's always been my strategy. I'll hunt for a company I like. I'll buy it. And the rest is history, and we'll wait. And it's a lot less stress on my end. I don't have to worry about managing volatility. I don't have to worry about that. You know how many investors I have? Zero, none. I have myself, and that's it. And I like it that way. And so I don't have volatility requirements. I don't have projected growth requirements or earnings requirements. I just have my own well-being to worry about. That's about it. So answering your question. Do I think I can? I think I can here and there. How accurate will I be over a long period of time? Probably not very accurate because there's so many moving parts. And I don't spend all day, every day contemplating that. For the most part, at any given point in time in past years, that I work. Okay, so I don't have all day every day to focus on a macro viewpoint. Even I've never had that as a point of like as a source of income. No one's ever paying me to sit around all day thinking about macro. So I would probably not even, because even referring to other quote unquote experts in the space, it's like, is that even that fruitful? It's good to listen to perspectives and just kind of get an idea of what things could happen, but the likelihood that that person also understands every single moving part, because it's really difficult, is very unlikely. So, it's always take it with a grain of salt. I take it as entertainment value. When I hear someone say their macro viewpoint, I don't hold them to account. Unless they, I'll poke fun at them if they say, this is what's going to happen in the next 6 months, and I'm going 100% this stock, or I'm positioning myself like 50% in hedging. And I'm like, all right, cool. I'll poke fun at you a little bit, right? In 6 months from now, if it didn't happen, but that's about it. Macro is scary. Macro is scary. All right, let me see if there's other questions that came through. Are you buying medtech right now? Yes/no. So I like what you did. You gave me 2 options to say. The answer is no, but I'm going to give you more than that. No, but I'm looking. And that's currently within the club. I'm looking alongside with people who work in the medical field, because there's a lot of stocks in that space that I'm really interested in. I see the sell-off and I'm like, hell yes, this is what I'm looking for. Because I have no medtech exposure. If you guys, both members of the club, see the holding co, and you see my personal holdings, go check out the updates. There's no medtech exposure since like 2022. So I don't have a player right now in that space. And would I like to have one? Yeah, sure. Why not? At the right price. Okay. Oh, another great question. So this is an academic question. Oh, wait. I don't want to skip SH's question. Thoughts on airlines right now? I'm long LUV. LUV is the only one I would ever buy, probably. But airlines, I don't like the business. I think that the real value, and this is opinion not shared only by me, but all the analysts in the club, that airlines, the true value add is in the plane build, the plane construction, the plane providers, and the components that go into those planes. That's all the companies that make all the money. And there's a lot of sectors that are like that, where there's one company or one sector that takes all the value, and then the scraps are left to the other businesses that literally just take the scraps. Airline companies are in the business of building out networks, and they actually make most of their money from the rewards programs. I don't know, most people don't know that. So fun fact, if you're buying into an airline, the actual business that's attractive is the rewards program. And if you want to, I forget what bank did an agreement with, but I know it was Delta Airlines. Delta Airlines tried to sell, was trying to offer something as collateral, but not the full business, not the rewards business. They were offering just the airlines, the actual planes, that network as the collateral in the loan. And the bank said no, and the commentary from the bank was saying that all the value is actually in your rewards program. And obviously Delta knew that. People who work in the field know that. And obviously in banking, they're not going to just miss that. Their due diligence team is going to do due diligence, proper due diligence. So LUV, one of the things that's really good about them off the top is like you have you have a net negative amount of debt. What I'm trying to say there is they have more cash than debt. You have a very simplified business strategy of just accumulating a ton of the same kinds of planes. And so you get obviously discounts on said plane because you're buying it so much in bulk. You get also better efficiency regarding parts, maintenance, training. There's a lot of benefits across the board there. And as far as customer satisfaction, Southwest typically scores among the highest. So you have a lot of things to like. Recent issues with airlines in general is concerns on travel projections. I know this because of the airport investments that I have. Yes, I'm invested in airports. I actually haven't revealed that publicly on YouTube, but club members know the airports investments. It was a recent opportunity that we took advantage of. You know what? We'll talk about it. F it. We'll talk about it. So just super quick deviation. So we bought actually PAC recently. I don't know how long I'll hold it for, but we had a recent buying opportunity, like literally right there. And if you were looking at this or this was on your watch list, you probably saw something really red that day. And yeah, that was the airports. It was the Mexican government coming in and essentially saying, we're going to remove some of the price increases that we allotted to you during the COVID pandemic, but now we're going to remove it. And then it rallied the day after because news came out then, not that bad. So yeah, we took advantage of that sell-off and we bought some shares. It was on the watch list. And the general consensus or agreement among us was, right now there's an outright panic, and it's not going to be as bad as what people project. But I think that this is another sector where there's actually more value extracted than the actual airline companies like Southwest Airlines. So, but yeah, if I had a gun to my head, I would definitely buy LEV over the others. Best ETFs for single moms. For single moms, they're probably, if they don't want to focus on investing and want to focus on their income growth, you would just do broadly diversified index funds, VTI, VT, VU. Simple, market cap weighted. But that would be the best for a single mom, assuming they're not investing in individual stocks because they want to focus on their main income and then their kids. Do you have an opinion on momentum factor investing and momentum ETFs? Seems like they have an empirical backing as a value factor. So yeah, broadly speaking, right now the industry is moving towards a factor investing as a marketing strategy. So different companies or different funds, different wealth managers are going to implement this to varying degrees of success. I would say that for the most part, most of them you're still going to be paying them to underperform a market cap weighted index. Most of them, and then a few of them are going to efficiently execute a momentum or factor-based strategy. Where the idea is you increase weighting to certain factors at certain periods of time, and your goal is to maximize returns, minimize volatility, all the shebang. So factor investing can be as extensive as you really want it to be, and as broad as you really want it to be. What I mean by that is you can separate all these companies into different factors, like small cap value, right? Now you have introducing two. Small cap value, United States. You see, we can keep going. And so the idea is you separate assets under certain factors. And so if you want a good resource, I mean, Vanguard publishes a lot of research or a lot of documents on like factor investing that you can kind of get a good idea of. There's plenty of interviews on YouTube on factor investing that you can also use as free. These are all free resources. You don't have to pay a course to do this. Free resources to learn more about factor investing and how you might want to either learn more and think about implementing a factor investing strategy in your portfolio. Or even do research because someone is selling you on a factor and based strategy and they're saying, hey, invest through us because we're going to implement this factor and based approach. Give me your money. Okay, well, you can be a bit more informed customer in that case. So what do I think about it? I think as far as like the theory goes, it's sound. Like there's nothing wrong with the theory. It's just in execution. I think that different strategies around factor investing are going to be implemented at varying quality. So I don't have the confidence to point out any particular firm that I can say is going to, outperform in a risk-adjusted basis or an absolute basis with certainty. I think that still the simplest and best approach for retail investors, so all of you listening, is just broadly diversified index funds. And by the way, like I said, I'm highly contemplating each and every day, quote unquote, retiring and plowing the lion's share of my investments, aka the personal holdings, into broadly diversified index funds and calling it a day. And then, I'm done. Taking in lieu of my recent successes. So I'll tell you, and this was always the case when I joked with the community, at $400 a share at Meta, I am done. That's like my current trajectory of like I wouldn't need to do anything else. But that, you know, partial luck, partial skill, whatever you want to call it, however much you want to allocate to whatever. Okay, so let me see. I don't want to skip anyone's questions. What should I get from Chipotle? Chicken bowl, brown rice, black beans, and pinto beans, some extra protein, or just double down on black beans. Just get more of those beans. You can do light on the rice. You want to lower down that carb rate. I always go with a lot of vegetables. So a lot of vegetables. You're going to increase your salt intake. So keep that in mind. Drink lots of water. If you want even more protein, you're willing to pay up for it. Double chicken. It's going to come out to about like 12-ish bucks. On the other side, when you get to the other side, I throw in corn in there. I do mild drained because I don't like it to, you know, liquefy, not liquefy, but soggy up the food. So mild drained. If you want some spice, throw that in there. No harm in that. But if you want to still be a little bit quote unquote healthier side, no cheese, but you want to throw in those calories because, you know, you're trying to bulk, throw in that cheese. I'd avoid the sour cream. Again, you don't excess calories, no need. And then if you kind of want, if you're willing to throw in 200 more calories, you throw in that vinaigrette. Vinaigrette will actually change the taste of the bowl entirely. It's pretty good. I recommend that. But yeah, so brown rice, chicken, vegetables, and, you know, varying amounts. But make sure to get those beans either double portion. That's good. And yeah, that's typically what I would get. A fun question, but I answered it nonetheless. Is a bit much. Trying to make me gassy. No. I scroll down just to see your response to me. The Warrior. I think what's happening. Oh wait, sorry. I don't want to skip Dark Knight. So Dark Knight. You see how much fun I start to have fun in these live streams, and then I say, "Oh, I'm gonna end it," and I never end it. And before I know it, we're live streaming for like 9 hours. Thoughts on, because generally I do have fun. That's actually again why I am even on YouTube. Thoughts on self-storage REITs like PSA. There's been an overbuild in the broader market, but I need to actually pull up PSA because I can't just say that without looking at the price because I haven't looked at it in a long time. There's like a recent big spike. What happened here? It's not that big of a spike. It's like 7%. Yeah, that's not big. So this is the overbuild. I published videos back in like 2022, or early 2022 about REITs in general that I was pretty negative. And McBuddha T reminded me the other day that all of like the private calls, you know, this is like the private content. I talked a lot about REITs this year, but also last year. Last year, my commentary was pretty negative on REITs. So last year, the themes were like liquidity crunch and such. And one of the asset classes I had unfavorable opinions on was REITs. 2023 rolls around. I think the club got really annoyed with how much REITs I started talking about because I said 2023 is a really interesting year to accumulate REITs. So I flipped pretty much a 180. But not all REITs are created equal. So that being said, public storage REITs, like PSA and a couple others, I think that they're still suffering from an overbuild. And overbuild kind of takes some time. It's going to take years for demand to catch up. What you basically had was COVID-19, people work from home. A lot of people want to create like a home office because they didn't have one, right? Well, you have that room full of stuff where you're going to put that stuff in a self-storage facility. That's a huge tailwind for public storage facilities. So you get PSA and the competitors all get that massive boost. Rental rates increase, et cetera, because increased demand, so they can afford to do so. And they project out that growth is going to continue forever. And so they build more and more and more and more. And obviously, real estate developers are really excited to do that. So they keep building more and more and more and more. So then you end up a situation where you have overbuild, supply or demand comes down, supply is projected to keep on increasing. That harms the forward projected rental growth rates and therefore harms the projected FFO increases for these REITs. Dividends increases, therefore projections should come down. So all in all, I don't really want to accumulate public storage REITs just yet. I think that there's other REIT opportunities. I won't bury the lead. I think like Agree Realty, which I want to have the CEO on for an interview. I'm going to work on that at some point here in the future, have him on for an interview. What I'll do is the interview will be private content for the club and then eventually be released to the public.
But I'm going to have that interview with the CEO. I'm going to have another interview with, I'm working right now on one CEO interview, which is also going to be really interesting. Club members can guess which CEO that is, but I reached out and looks like we are going to get that going. So yeah, and it's just going to be discussing pretty much like the business model. We're not going to be discussing it directly like, oh, your stock's cheap, blah, 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 everyone should go buy it. No, it's just going to be like, okay, kind of questions explaining, hey, how's the business model? Questions pertaining to that, really. So investors can kind of get that idea or map out better like how it is they operate. So yeah, there's some REITs that I think are much better opportunities. If you were trying to play like Class A office REITs, we talked about two before, BXP, KRC. You have industrial REITs. Industrial REITs, you have many different flavors in there. You have Rexford Industrial Properties. You get that California reshoring Mexico exposure. You could also go with Granite. Granite has some like crappy properties here and there, but some good properties as well. The spinoff from Magna International. You also have Stag Industrials, which is kind of changing their portfolio strategy more so recently from value add to more high quality. Value add just means they get a lower quality property, they do some improvements, and now it's a value add to the portfolio, to the property, and they can get better rental rates. You have Prologis, which is the big boy, kind of, it's just there. I don't really see much growth coming out from them because they've grown. They're already so big. It's like it's hard to grow when you're that big. You also have some high quality that's getting cheaper and cheaper and cheaper. Realty Income, Vici Properties. I don't know about Vici Properties being so cheap, but Realty Income's getting there. But a lot of similar problems with being so big and growing. WP Carey, absolute destruction going on in there. Business transformation underway. They're spinning off their single family tenant office buildings, which are kind of bad properties to begin with. You don't really want exposure to this or to those properties. Like you can think of ONL being the spinoff from Realty Income. But yeah, WP Carey in general, their spinoff is of a similar nature. They're trying to simplify their portfolio, get rid of the underperforming assets. I'm trying to think elsewhere, yeah, but there's a bunch, really. There's a bunch of REITs out there that you could get. I'm sorry, I just like, I need to go through this. There's so many more questions that just came up. What do you think is happening in the bond market, creating a big waves, which are, wow, I need to catch up. Okay, hold on. I'm going to go through a lot of these quickly. I apologize. As nobody, I think, is a good thing in the long run, but 5 years, your opinion. Okay, wait. I think what's happening in the bond market is creating a big waves, which are fully discounted. As a nobody, I think it's a good thing in the long run, but for 5 years, it's not. Your opinion. Which are fully discounted. I think that the bond market it's still kind of unknown. So like my armchair, I say that, sitting in a chair, my armchair macroeconomist opinion is that the bond market is telling us there's going to be some sort of unknown crisis in the future, unknown financial crisis that we have yet to kind of see what's going to be the cause. We had contango in the oil markets in October 2022. Trying to remember off my memory. October 2022, we had a contango moment in the oil markets, which basically in summary means that the oil market's concerned about forward demand. Contango in, I think it was February, March of 2023. And I believe we had another contango moment in June 2023. So that market is also kind of alluding to a similar issue. But bond market has been inverted for a very extended period of time and has had a large inversion at that. And so we had a whole private call about this actually, and some of the members were having very good back and forth questions. The discussion was wonderful. But trying to remember, I might even release that. I actually might even release that video to the public. I'll think about it. But that conversation I think was good. I might even snip it out and just release it. But where was I going with that? So typically how each time the yield curve inverts, you get a reversion by the long end reverting. And so you get a change obviously in the short-term interest rates across time. That's influenced by Federal Reserve policy on the short end, because the short end is heavily affected by Fed policy. The long end is where you get into a bit of a question mark. The long end is less sensitive to current Fed policy. Short end is. So on the short end, the inversion implies, right, that you have short end rates being at a higher rate than the long end of the curve, which is out of whack, right? Because you would assume, right, long end is more risk because you're lending your money out for a longer period of time. On the short end, you are lending out your money for a shorter period of time. And thus, the short end should be at a lower rate to the long end. That's in a normal environment. When you have the reverse happening, we call that an inversion. And typically, people use the 2 to 10 year comparison. You can use any variation, but the typical is the 2 to 10. And when you have an inversion, you can judge it based off of the duration of the inversion and how deep the inversion occurs. And so right now we've had both a very long duration of an inversion and a very deep inversion at that. So historically, this has been a sign to observe something that the bond market is concerned about. This could be the exception, and those who have the answer, hey, invest accordingly. But this could be the exception, and we could continue to rally. We're still in a bull market. The economy's great. Or this could be more in line with previous observations in that we are going to see some sort of economic correction, recession, etc. And so the bond market's concerned about that. So over the next 5 years, as part to your question, as nobody, I think it's a good long run, but for the 5 years, no, it is not. I think what's happening in the bond market is creating big waves are fully discounted. So I don't know if they're fully discounted. I think that we could still see some surprise. I believe the banks are a bit concerned, especially in the regional side, are a bit concerned if this continues to, let's say rates continue to go to the upside. Because remember that a lot of these banks have a lot of duration risk. We had a whole conversation today in this live stream about that. So the duration risk is still prevalent, and some are more exposed than others. So I would kind of like look out for that. But yeah, I want to get to the other questions. Sorry, there was way more that we can talk about that. But a capital mindset knows more than financial education. Oh, I'll take that as a compliment. Oh, and Hello World outs me again. I am impressed. Oh, thank you, Hello World. Your selection of Chipotle is a bit... Oh, I already read that. We have fun here at Capital Mindset because of memes. Exactly. Any thoughts on Medical Properties Trust? Would appreciate it. So I had a Medical Properties Trust as a speculation. I have a video on it. You can check it out. I got accused of having a short position from some of the viewers at the time. But... just simply put, there was a lot of signs of potential fraud undergoing. So essentially, they were extending deals to their tenants to keep them in business for longer. And Medical Properties Trust was once considered like a very safe stock. It's like, oh, hospitals, I rent out hospitals. Is now under question of whether or not it will go BK. I would say the hospital business is very difficult business. Or a very difficult property type. If you think about it from the perspective of Vici, I say this a lot, and it's true. I think it's very true. It's a double-edged sword, right? You have hospitals are very difficult to build a new one. Like you can't just build a new hospital right across the street. You can build one within certain parameter of distance according to local code and local county rules, et cetera, or local council rules, really. And so when you're, can we look at Rick's, please? I see that. You guys are guessing who the interview is. I'm not going to confirm or deny anything. Okay, I see some good questions down at the bottom. Anyways, so MPW, where I lost the MPW question. Okay, there it is. Okay, MPW. If the fraud is true, it has so much more to fall. Like it could be a zero. And so why I even had a small speculative position in it was to effectively say, okay, well, what happens if it's wrong? And that's what I say in the video, right? In the video where I'm talking about the risks, which turn out to be seemingly more and more true, is the potential for fraud. And I outlaid, and I actually even played one of the videos of an interview of the analyst who was talking about the potential fraud going on in Medical Properties Trust. And so it's still potential. It's alleged. It's not proven. It's not proven at all. But the market doesn't necessarily need to be 100% certain about fraud. It just has to smell. There has to be smoke, and then maybe there's a lot of smoke. And where there's smoke, there's potentially fire. But Medical Properties Trust, I believe they cut the dividend already, if I remember correctly. And there might be a point where there is value, because I'm not saying they don't own there's properties in there, but they might have been engaged in unfavorable practices with their tenants, and that's kind of what they have to deal with. And that could lead to severe underperformance for a long period of time, because not only do you have to contend with the fact that as a business you are making yourself look better, well, now there's a whole trust issue. Management has lost all credibility, and you need a whole new management team in there, unfortunately. So it is what it is. Fabio will be interviewing the CEO of TTCF. We'll finally get a good paid for. Oh my gosh, stay tuned. Yeah. I see a lot of people are guessing some companies. Can we look at Rick's, please? RCI Hospitality. I see. All right, we'll look at Rick. Rick is falling. And then we had a question about any small caps you like, Fabio. Yeah, there's actually a bunch, not a bunch, but there's a good amount of small caps that I'm invested in. Most of them make it into the holding co. I don't really talk about them too much publicly, but in the holding co and the club, there are some small caps that I do accumulate. But yeah, Rick's is one of them. I'll say that. And honestly, it's a good company. There are some issues, and it's kind of it's not a joke company. I think it started off as like looking at it, I was like, this is a funny company because they own strip clubs and stuff. But no, there's some serious merit underneath it all. I think small cap as a factor, right, has really underperformed this year. And so, you're kind of contending with the potential opportunity that exists in the small cap space. So I'd say like among the rubble, there's a lot of opportunity here. But generally speaking, if your portfolio has been really concentrated outside of large cap tech, I don't think you've done very well in 2023. How do you go this long without eating or drinking anything? Have you been taking Ozempic? Surprise, yes, I have. So this is how I would normally be, because generally when I have a work day, right, when I'm working, I don't even remember to eat. I'll just work through lunch, and then I'll get home, maybe go to the gym, but I'll eat a very big meal. I'll eat very big individualized meals. Like I'll have a very big dinner. Those of you who were in the voice chat with me or the voice call with me last night, because we do a lot of that within the club. We're also like, you could argue like a very close-knit group of people at this point. And so some people participate, like we do randomized voice calls, and I was cooking a steak last night, which for the most part ended well. Some of you know the nuance of like why it ended not the best. But yeah, I'll eat a lot of, my diet consists pretty much of meat, fruits, and vegetables, and that's pretty much it. ASMR in the club, bullish on NVO for Ozempic. Bullish on Novartis. Reminds me of Hawaiian Electric. Yeah, Hawaiian Electric, my God, what a destroyed company. But yeah, Hawaiian Electric, how they've done. Let me just pull them up real quick. By the way, shout out to everyone still watching, because we've gone 3 hours and 43 minutes, so nearly a 4-hour stream. This is the problem with you people. You guys ask me questions, and I just like say, I'm going to keep it at 1 hour. I'm going to keep it at 2 hours. Oh, no, 4 hours. Next thing I know. 4-hour stream. Dear God, you people. I blame all of you. But yeah, I agree. Ozempic is overhyped. Ozempic is definitely overhyped. Can we interview the CEO of Rick's? Well, can the stream be joking now? I don't know what that means. Bobby calls us you people. Well, we can do a separate stream, Cole, because I'm down with doing. That means can I come on? No, we can do a separate stream that's more like relaxed, because I want to keep the content almost separate from serious to non-serious. In fact, I'd be down to go on a stream on your channel if you want to do a relaxed stream. We can do a stream on your channel. Good idea. Yeah, no. If you want to do a relaxed stream, definitely, just we can do a stream on your channel. More like Syria, not non-Syria. I'm always serious. Okay, can you talk about this website you're building? JMac. It's not really my place because I'm not the CEO and founder of it. So I can't talk about it too much. But once like if I have like their permission and such at some point in the future, like I will of course, talk about it more. But yeah, soonish or tonight. Let's do it tonight. Investing in coal. We'll do it tonight because that gives me time to go do my exercise, cook my dinner, etc. Yeah, no, by the way, JMac, like it's not, I love answering questions, any kinds of questions. Like you guys don't understand. You guys can ask like pretty much any question right now. And I'm open to answering it. Again, like I don't believe in necessarily, like for example, if people ask me, hint, hint, nudge, nudge, you ask me about the holding co, I'll answer questions about the holding co. It's not that I'll say like, oh, I'm not going to answer that. You're not a club member. Go F yourself. I don't do that. Thanks, Fabio, and thank you all. No, thank you, Bacon Memes. All right, with that being said, if there's no more last minute questions, I'll give like 5-ish minutes for any last minute questions. Otherwise, I'll end the stream here. So give it your best shot, everyone, if you have any last minute questions. Otherwise, thank you so much for joining me on a Sunday. I know it's a football day. Payroll companies. I saw your question. I didn't mean to ignore you. Paycom, Paylocity. And why Paylocity? I think that Paycom's product is very good. Their pricing model is quite interesting. We know this because we actually have members of the club that Paycom and Paylocity will go and ask them for or pitch them their services. And so we were able to compare from a customer standpoint which one was marketing themselves better. And then we could also obviously look at the public data and value for ourselves, which one also has better internal return metrics, which they were both very good. And then different nuances about the business models which both of them share on payment software companies. As far as like with rates rising, how does that benefit each one? And we were able to kind of determine Paylocity was our choice. But Paylocity. I'm going to bed. Oh yeah, no worries. Thank you guys for all joining. And then we'll give it some more time here for last minute questions. What's the best way to thaw out a chicken in 15 minutes? That's a random question. 15 minutes? No, be patient. Give it some time. It's a great question. Would you rather fight 10 dog-sized elephants or one elephant-sized dog? What kind of wait, this is the trick. Okay, do they maintain the same density? I know I'm looking too deep into it, but would they maintain the same density as dogs, and what kind of dog? That's very important because that would change everything. Everyone is sleeping on BTI makes me sad. All right, I'll talk about BTI. BTI has the benefits of not payment volumes. All right, forgive me, it's been 4 hours. Volumes have come down. They're going to keep going down, but that's been the narrative for a long time. The only problem is the debt. That's it. If they fix the debt, I'll be there with you buying shares. Okay, we have another question from Patrick. Do you think it would be bored if you retired so early? No. Let me clarify what I mean by retirement. I have benefited from good fortune on my personal holdings. And many of you have asked me, because you're looking at it and saying, hey, it would maybe make sense. Like you're basically, a lot of you give me good friendly advice. A lot of you are older than me, even younger than me, but older than me, and have more life experience. And I acknowledge my weak points as far as, inexperience in life goes. So I acknowledge, and I said this in the past, I have a bias when it comes to individual stock investing because of my past performance. It colors my confidence in future performance. And so many of you point out, hey, you've done really well, but you might want to, take advantage of the luck or skill or whatever that you've had, and consider also what you're going to be doing with your job wise, because many of you know what my next job is going to be. It's going to be I'll have a lot of control over the time, right, when I work, but the amount that I work is probably going to elevate to another standard. And so, hey, why not just because you still want to do capital mindset and run the club and everything. So why not just alleviate some of that pressure via, putting your personal holdings into an index fund? That's the idea behind it, and that's it. It's not like actual retirement. I will probably never retire, but that's the idea. And so the holding co remaining an individual stock-based portfolio, and then personal holdings just going to like VU VTI or something like that, and calling it a day. That's what I refer to as retirement. So it's not actual retirement. Okay, so now it got back. Dan Weston, would you? Okay, no. 10 dog-sized elephants. Because it would be premature. Oh, no. You thought of it in that way. Easier run away from one than 10. But here's the thing: if they have the same mass density as an elephant in the size of a dog, let's say it's a Chihuahua, but it's the body of a Chihuahua, they wouldn't be able to even chase me. Their bones would be crushed. So, I'd take that. They wouldn't even be able to be a threat. So that's how I'm thinking about it. You wouldn't need to run. Yeah. They would be stillborn. Wow. I mean, if you're thinking about it in that way, yeah. So I think that's my question. All in Baba. Only thing that scares me is Michael Jordan. So not to like shout out my old videos, but I'll shout out my old videos. So feel free to check out SH. By the way, I don't know. Yeah, I think you might be a newer subscriber, but check out, my old videos on Alibaba. I have a lot of them. I feel like you might find them interesting. There's like reasons why I don't like Alibaba beyond like the Michael Jordan. So, yeah, just food for thought. Baba is the new Amazon. Hail to the nah. All right. Now I'll give a brief period, specifically not owning the shares, actually, right? Yeah, and it's a bit more nuanced than that, but that's like the tip of the iceberg. Michael responded. What did Michael responded? I don't maybe know. Did we ever do? No, we didn't. Thank you. Okay, I'll cover Discover. My issues with Discover, current circumstance, CEO steps down because of I think like they found an internal control that was improperly set. And so they discovered it themselves. So now they're working with regulators. CEO steps down. That could imply that it's worse than what management is saying right now. Maybe it's not. I don't know. Looks really cheap. Share cannibal. I don't like necessarily the customers they target. They target more on like the subprime, not subprime. Let's call it more beginner credit journey people, consumers. But yeah. How many 6-year-olds could you take on in a fight? I don't know. It would depend if they're coordinated or not. Like it would honestly, it depend if they're, it would really depend if they're coordinated. Because if they're not coordinated, I assume a grown man could take on hundreds. It'd just be a matter of getting tired. Like, and I'm assuming it's bare hands. So 6-year-olds, like if they're not coordinated, you could, before you get tired, you could probably take on like 100, because they can't even, they're not even physically capable on a one-on-one basis of even causing physical harm to a grown man. So it's interesting question, but and then you assume like the average grown man or the above average grown man in terms of like physical strength. So if you're above average physical man, maybe in the hundreds, like maybe close to 1,000 if they're non-coordinated. But if they're coordinated, 6-year-olds all have knives, and if they all have knives and they're coordinated, even if they're not coordinated, I think eventually, once you get tired, that becomes a huge factor. Yeah. They hit you in the family jewels. Again, coordinated. Fabio is speaking from experience. Oh my God. No, I'm just looking at that. And they're hungry. Knives and they're hungry. Okay, you guys are adding more things. Fabio challenges 106-year-olds to fight of life and death. You guys have great imaginations. I'm just reading your chats. All right, I'll open it up for now 3 more minutes and I'll close it off. Any last minute questions? That was my thoughts on Discovery. Like it's value. There's value here, but oh god, 6-year-old knives, 6-year-olds, 60-year-olds with a baseball bat. Oh, Disney. Yeah. Okay. Cool. So Disney, I am watching them. I actually have a position in Disney, rather small, but target allocation if the market allows me, of about 5-ish%. Not gonna be the same size as Netflix, but hey, I see it. There's a place of Disney in the portfolio. I'm looking at the 3 points that I laid out as far as like what the business has to accomplish. Real quick, is like change in management, check. More neutralization in the culture wars, check. And CapEx investment into the parks, check. All three have occurred or are occurring or in the process of occurring. And so I've discussed this with the club extensively, but basically I am buying Disney. I'm being patient with it. I don't think there's a rush necessarily because they have to still prove themselves. Nelson Peltz coming in and saying he's going to involve himself a little bit more. Yeah. Oh, someone's asking the great question, the big question. Oh, well, there's a recession. Will it be next year? I have no idea, but we're having fun. You have to understand where I'm going to come to you in this conversation of just banter between two grown men. Sure. Yeah. Recession next year. And then I'll quantify that. I'll back that up with some observations. Like there's potential for, strong consumer demand destruction via higher input costs, higher energy prices. Necessity is not coming down in price. It's just disinflation. Discretionary spend has already been shifting away in the consumer's receipts. And, you have had, strong wage growth in the top ends of the market, but not on the bottom ends of the market. And as the top end of the market starts to slow down in terms of wage growth, we are, potentially going to observe a spike to the downward in consumer discretionary spend even more than before, which could, in fact, yes, lead to short-term recession. But hey, bond market's scared of something. You also have some, we're kind of black swans because we can observe them. The potential escalation of war in Israel with Iran getting involved in the mix. Like I just mentioned, they just put a red line on the Israeli conflict. If Israel invades, they claim that they are going to also react. This could have impact on energy prices further and, further increasing input costs. So, hey, we're just paying attention to all that. But that was like today. I think that's like updated news today. Thoughts on Paramount? Don't like it. Just in one sense, don't like it. Paramount. I think that there's a lot of, so the thing is the legacy business of CBS, I don't think there's going to be that many players in the end for streaming. I don't think so. I think there's going to be, I want the top 2 players. That's the only ones I want to invest in. I do believe that is going to end up being Netflix and Disney. Strong possibility there. Maybe Warner Brothers. Maybe Warner Brothers Discovery. It's going to be that second player. Top 3 is easy for me to see. I could be wrong, but I see it as being Netflix, followed by either Disney or Warner Bros. Discovery. Those are going to be the top 3. Current opinion. Thoughts on healthcare stocks. I'm looking at healthcare stocks right now. That's actually my main interest. One of my main interests. You have challenged Paul to a duel. What is your weapon of choice? The color green, because he doesn't know what it looks like. The problem with the recession question is that unemployment rises. We expect the Fed to act accordingly. Yeah, but that hasn't really stopped changes in market moves when a recession occurs. The Fed always acts accordingly. Which rate is cut? Disney Plus app needs a lot of work. Yes, it does. It needs a lot of work. They need to consolidate. One viewpoint that you can look at is Disney still has near monopoly on child content. So we think about BTI. We talked about BTI earlier, but generally speaking, yeah, it's cheap. I only have a problem with the debt. Otherwise, looks like a cool opportunity. Potentially good opportunity. All right, we passed the 4-hour mark. So congratulations to all of you that witnessed this. If you guys liked the live stream, Another 5 minutes passed after he said 3 more minutes. I know. It's because you guys keep asking questions, and I can't help but answer them. Okay, so other than that, I will let it go here. Thank you guys. Oh, thank you, James Burns. Thank you. Thank you guys so much for watching. If you guys enjoyed this live stream, feel free to leave a like. That's how it lets me know that you want more of these. Can't promise they'll always be 4 hours, but heck, if you guys keep asking me questions like that, they'll be 4 hours, easy, without even trying. But yeah, like the stream if you guys enjoyed it. Can we watch the stream later on YouTube? Yeah, no, it's gonna be here. It's gonna be here. So 4 hours of content, right? And for those of you who were wondering for whatever reason, because I've already said it before, if you're in the club, this is not the Sunday call. This is not the weekly call. That's going to happen later this week. So thank you guys so much for watching. It was really fun. And I hope you guys have a great day, whatever it is you guys are doing. Great night if you're in the Eurozone, or great morning if you're on the other side of the world. With that being said, I'll see you guys on the next one. Bye.